IFRS and ESG compliance, bridging financial reporting and sustainable responsibility. Table of content. Chapter 1, Introduction to IFRS and ESG. Chapter 2, History and Evolution of IFRS. Chapter 3, The Rise of ESG, Environmental, Social and Governance Principles. Chapter 4, Convergence of Financial and Sustainability Reporting. Chapter 5, The Regulatory Landscape, Global Bodies and Frameworks. Chapter 6, IFRS S1 and S2, The Core of Sustainability Disclosure. Chapter 7, Implementing ESG Reporting Systems. Chapter 8, ESG Assurance and Auditing. Chapter 9, ESG Disclosures for Investors. Chapter 10, Industry-Specific ESG and IFRS Compliance. Chapter 11, Technology and Tools for IFRS ESG Compliance. Chapter 12, Governance and Internal Controls for ESG Compliance. Chapter 13, Assurance and Verification of ESG Disclosures. Chapter 14, Emerging Trends in ESG Regulation and IFRS Standards. Chapter 15, Practical Steps for Implementing IFRS ESG Compliance in Your Organization. Chapter 16, Case Studies in Successful IFRS ESG Compliance. Chapter 17, The Future of ESG Reporting and IFRS Standards. Chapter 18, Integrating ESG into Corporate Strategy and Risk Management. Chapter 19, ESG Reporting Tools and Technologies. Chapter 20, Training and Capacity Building for IFRS ESG Compliance. Chapter 21, The Role of External Assurance in IFRS ESG Reporting. Chapter 22, Aligning IFRS ESG Compliance with Corporate Ethics and Culture. Chapter 23, ESG Compliance in Different Industry Sectors. Chapter 24, IFRS ESG Compliance for SMEs. Chapter 25, Regulatory Landscape and IFRS ESG Compliance. Chapter 26, The Future of IFRS and ESG Compliance. Chapter 27, Case Studies in IFRS ESG Compliance. Chapter 28, ESG Data Management Systems. Chapter 29, Assurance and Verification of ESG Reports. Chapter 30, Integrating ESG into Corporate Governance. Chapter 31, Industry-Specific IFRS ESG Compliance Guidance. Chapter 32, Practical Tools and Resources for IFRS ESG Compliance. Chapter 33, Communicating ESG Performance to Stakeholders. Chapter 34, The Future of IFRS ESG Reporting. Chapter 35, Case Studies in IFRS ESG Compliance. Chapter 36, Summary and Final Thoughts. Chapter 1, Introduction to IFRS and ESG. 1.1 Overview. In the 21st century, businesses are under increasing pressure to operate transparently, ethically, and sustainably. Two major forces are shaping this new business paradigm: International Financial Reporting Standards, IFRS, and Environmental, Social and Governance (ESG) principles. Historically, financial reporting and sustainability were managed separately, but today the boundaries are dissolving. Investors, regulators, and consumers are demanding more than just balance sheets. They want to know how businesses affect the planet, treat people, and govern themselves. IFRS provides the globally accepted framework for financial transparency, while ESG addresses the ethical and sustainability dimensions of business performance. Together, they are redefining corporate accountability. 1.2 What is IFRS? The International Financial Reporting Standards, IFRS, are a set of accounting rules established by the International Accounting Standards Board, IASB. Their purpose is to bring consistency, transparency, and comparability to financial statements across international borders. IFRS is used by over 140 countries and is considered the global language of business reporting. Key goals of IFRS: ensure comparability across industries and countries, enhance investor confidence through reliable reporting. Promote transparency and accountability. Support efficient capital allocation. 1.3 What is ESG? Environmental, social, and governance, ESG, refers to the three central factors used to measure the sustainability and societal impact of an organization. ESG is not just about compliance, it's about identifying risks and opportunities that traditional financial analysis may overlook. Environmental criteria consider a company's impact on nature, carbon emissions, water use, energy efficiency, and waste management. Social factors assess relationships with employees, suppliers, customers, and communities, issues like diversity, labor standards, and human rights. Governance involves the internal system of practices, controls, and procedures, board diversity, executive pay, audits, and ethics. 1.4 Why are they connected? Though they originated from different needs, one financial, the other ethical, IFRS and ESG are converging due to growing demand for comprehensive disclosure. Integrated reporting. Investors want to see how ESG risks and opportunities affect financial performance. Standardized metrics. Just as IFRS unified financial accounting, there's now a push to standardize ESG reporting, e.g., ISSB under IFRS Foundation. Regulatory pressure. Many jurisdictions are making ESG disclosures mandatory, just like financial disclosures. 1.5 Global momentum for ESG and IFRS integration. In 2021, the IFRS Foundation launched the International Sustainability Standards Board, ISSB, to create a comprehensive global baseline for ESG disclosures, much like IASB did for financial standards. This marks a significant step toward integrated reporting, where ESG and financial data are part of a single reporting system. This integration ensures that sustainability is not just a separate, feel-good report, but is embedded in the financial decision-making framework. 1.6 Challenges in implementation. Combining IFRS and ESG is not without challenges. Data collection. ESG data is often qualitative, non-standardized, or hard to verify. Skills gap. Many finance professionals are unfamiliar with ESG principles. Greenwashing. Without robust assurance, ESG claims may be exaggerated or misleading. Lack of global ESG standards. While IFRS is widely adopted, ESG frameworks remain fragmented. 1.7 The purpose of this book. This book aims to provide a clear understanding of IFRS and ESG principles. Examine their integration and evolving global standards. Offer guidance on compliance, risk management, and reporting. Share real-world case studies and best practices. Whether you're a financial controller, ESG officer, auditor, investor, or policymaker, this book will serve as a comprehensive guide to navigating the complexities and opportunities at the intersection of financial reporting and sustainable responsibility. Chapter 2: History and Evolution of IFRS. 2.1 The need for global accounting standards. Before IFRS, countries developed their own generally accepted accounting principles, GAAP, tailored to national needs. However, globalization in the late 20th century highlighted the limitations of fragmented accounting standards. Investors struggled to compare financial statements across borders, and multinational corporations faced costly compliance with multiple reporting regimes. The solution? A unified global accounting framework that would promote transparency, comparability, and trust in financial markets. 2.2 The birth of IFRS. The origins of IFRS date back to 1973, with the formation of the International Accounting Standards Committee, IASC. The IASC's mission was to develop international accounting standards that could be adopted globally. From 1973 to 2000, the IASC issued a series of International Accounting Standards, IAS. Although these were influential, they lacked enforcement mechanisms and global legitimacy. Recognizing the need for a stronger governance structure, the International Accounting Standards Board, IASB, was established in 2001 by the newly created IFRS Foundation, which replaced the IASC. 2.3 Timeline of key milestones. 2.4 Objectives of the IFRS Foundation and IASB. The IFRS Foundation is a non-profit organization that oversees the IASB. Its mission includes developing high-quality, understandable, and enforceable global standards, promoting consistent application and rigorous governance, engaging stakeholders across regions and sectors, supporting emerging economies in adopting IFRS. The IASB, as the standard-setting body, is responsible for drafting and updating the IFRS standards through a transparent process involving global consultation. 2.5 Structure of IFRS standards. IFRS includes two main categories. IFRS standards, e.g., IFRS 9, IFRS 15, IFRS 17. These are issued post-2001 by the IASB. IAS standards, e.g., IAS 1, IAS 2, IAS 12. These were inherited from the IASC and remain in force unless replaced. Each standard consists of objectives, scope, recognition and measurement principles, disclosure requirements, effective dates and transitional provisions. 2.6 Global adoption and impact. Over 140 jurisdictions now require or permit IFRS for public companies. Key adoption developments include European Union mandated IFRS for listed companies in 2005. Asia Pacific, Australia, South Korea, and others fully adopted IFRS. Africa and Latin America, widespread adoption among stock exchanges and regulators. United States, while still using US GAAP, the US allows IFRS for foreign filers and collaborates with IASB via the FASB. Adoption of IFRS has enhanced investor confidence, cross-border capital flows, M&A efficiency, comparability of financial reports. 2.7 Ongoing challenges and criticism. Despite widespread success, IFRS faces some criticisms. Complexity. Some standards, e.g., IFRS 9, IFRS 17, are difficult to implement. Judgment-based, heavy reliance on estimates can reduce consistency. Cultural differences. Application varies by region, particularly where legal systems and corporate cultures differ. Lack of universal convergence. The U.S. continues to maintain a separate system, US GAAP, though convergence efforts exist. 2.8 The road to integration with ESG. The IFRS Foundation's decision in 2021 to launch the International Sustainability Standards Board, ISSB, signaled a major pivot, from focusing solely on financial standards to embracing sustainability and ESG disclosure frameworks. This marks a new chapter in IFRS history, one that recognizes the interdependence between financial performance and non-financial factors such as climate risk, diversity, or governance quality. The goal? To create a single global reporting baseline that integrates both financial and ESG data for decision-makers worldwide. 2.9 Conclusion. The journey of IFRS, from a fragmented effort to a globally dominant reporting system, has transformed how businesses communicate their financial health. Now, as ESG becomes a defining element of value creation and risk management, IFRS is evolving once again. Chapter 3: The Rise of ESG, Environmental, Social, and Governance Principles. 3.1 From CSR to ESG, a paradigm shift. Corporate responsibility is not a new concept. Since the 20th century, companies have engaged in corporate social responsibility, CSR, efforts to give back to communities, improve employee welfare, and support social causes. However, CSR was often disconnected from core business strategies and lacked standardized metrics. Enter ESG, a framework that links non-financial performance to financial relevance. Unlike traditional CSR, ESG integrates ethical and sustainability considerations directly into a company's risk profile, valuation, and governance structures. It has become a strategic imperative, not just a philanthropic gesture. 3.2 Origins and early drivers of ESG. The term ESG was popularized in the 2004 United Nations report, Who Cares Wins, which argued that integrating ESG into capital markets leads to better investment outcomes. Since then, global momentum has accelerated due to climate change awareness, e.g., IPCC reports Paris Agreement, corporate scandals, e.g., Enron, Volkswagen emission scandal, social justice movements, e.g., #MeToo, Black Lives Matter, investor pressure, e.g., BlackRock sustainability mandates, regulatory mandates, e.g., EU Green Deal, SFDR. These drivers have reshaped how investors, boards, and regulators evaluate long-term corporate value. 3.3 ESG defined the three pillars. Environmental E covers a company's impact on nature and its efforts to mitigate environmental harm. Key issues include greenhouse gas emissions, climate risk and carbon footprint, energy use and renewables, water and waste management, biodiversity and deforestation. Social S assesses how companies manage relationships with employees, communities, customers, and suppliers. Key issues include labor rights and workplace safety, diversity, equity, and inclusion, DEI, human rights and supply chain ethics, consumer protection, community engagement. Governance G evaluates leadership, internal controls, and shareholder rights. Key issues include board diversity and independence, executive compensation, ethics and transparency, anti-corruption practices, shareholder voting rights. 3.4 ESG as a financial risk and opportunity. ESG factors are increasingly seen as financially material. Climate disasters, regulatory penalties, reputational damage, and social unrest can lead to real losses in shareholder value. Conversely, ESG-focused companies tend to outperform peers in the long term, attract more investment capital, enhance brand loyalty, reduce regulatory and litigation risk. Asset managers, insurers, and lenders now incorporate ESG scoring into investment decisions, credit assessments, and portfolio management. 3.5 ESG ratings and data providers. To quantify ESG performance, a growing ecosystem of rating agencies and data platforms has emerged. These include MSCI ESG Ratings, Sustainalytics, Bloomberg ESG Disclosure Scores, Refinitiv ESG Scores, ISS ESG Ratings. However, ESG ratings lack consistency. The same company might receive vastly different scores from different providers due to methodology gaps, lack of transparency, and inconsistent data sources. This fragmentation underscores the need for standardized ESG disclosures, which is where IFRS and the ISSB step in. 3.6 Regulatory momentum behind ESG. Regulators around the world are pushing companies toward mandatory ESG reporting. Notable developments include EU taxonomy and SFDR require investors to disclose how they integrate ESG factors. US SEC climate disclosures, proposed rules to mandate climate-related risk reporting. UK TCFD alignment, all listed companies must align disclosures with the Task Force on Climate-Related Financial Disclosures. Asia-Pacific, Singapore, Japan, and Hong Kong have introduced mandatory ESG frameworks for large issuers. These changes signal a future where ESG disclosure is no longer optional, but a compliance requirement. 3.7 ESG and corporate strategy. Companies now treat ESG as an essential part of their core strategy. This involves materiality assessments, identifying which ESG issues are most relevant to the business, KPIs and goal setting. Setting measurable ESG objectives tied to executive compensation. Stakeholder engagement. Consulting investors, employees, customers, and regulators. Integrated reporting. Merging financial and ESG data in a single report. When done effectively, ESG strategy helps future-proof businesses against systemic risks while creating long-term stakeholder value. 3.8 Common challenges in ESG implementation. Despite its growing importance, ESG adoption faces several obstacles. Data availability. ESG data is often self-reported and unaudited. Fragmented standards. Too many reporting frameworks and metrics create confusion. Greenwashing. Companies exaggerate ESG claims to appear responsible. Short-term pressure. Quarterly earnings demands often conflict with long-term ESG goals. Skill gaps. Many finance and compliance teams lack ESG training. These issues emphasize the need for integrated, globally accepted standards, which IFRS aims to provide through the ISSB. 3.9 ESG's future, from compliance to value creation. The future of ESG lies in mainstream integration, where sustainability factors are embedded in financial analysis, operational risk management, and corporate governance. Investors will demand decision-useful ESG data with the same rigor as financial statements. Companies that lead in ESG will enjoy access to cheaper capital, greater brand equity, and regulatory goodwill. Stakeholders will expect evidence-based accountability, not just narratives. The convergence of ESG and financial reporting, led by global initiatives like the ISSB, is paving the way for a new era of corporate transparency and performance. 3.10 Conclusion. ESG has evolved from a niche ethical concern to a strategic and financial necessity. As climate change, inequality, and governance scandals continue to shape markets and societies, ESG performance will increasingly determine long-term corporate success. Chapter 4. Convergence of Financial and Sustainability Reporting. 4.1 The Historical Divide. Traditionally, financial reporting and sustainability reporting evolved on separate tracks. Financial reporting focused on monetary performance, revenues, costs, assets, liabilities, and profits, using standardized formats like IFRS or GAAP. Sustainability reporting focused on non-financial impacts, carbon emissions, labor practices, governance ethics, using voluntary, often inconsistent frameworks like GRI, SASB, or CDSB. This separation worked for a time, but as global challenges such as climate change, inequality, and data ethics became financially material, the boundaries began to blur. 4.2 The Push for Integration. Investors, regulators, and stakeholders began demanding a comprehensive view of corporate performance, one that accounts for both financial health and sustainability risks and opportunities. Key forces behind this shift. Investor demand. ESG risks affect long-term value. Climate risk, for instance, can materially impact asset valuations. Risk management. Non-financial risks, e.g., supply chain ethics, cyber governance, are now board-level issues. Regulatory action. Mandatory ESG disclosures are being rolled out globally. Stakeholder expectations. Consumers, employees, and communities expect transparency and purpose-driven leadership. The result is a push for integration, a single, unified reporting approach that communicates both financial and ESG performance in a coherent narrative. 4.3 The Rise of Integrated Reporting. Integrated reporting, less than IR greater than, emerged as a framework that blends financial and ESG data into one holistic document. Developed by the International Integrated Reporting Council, IIRC, less than IR greater than aims to provide insight into how an organization's strategy, governance, performance, and prospects lead to value creation over time. The less than IR greater than framework emphasizes capitals beyond finance: human, natural, intellectual, social, and manufactured capital. Connectivity of information. Strategic focus. Future orientation. Though voluntary, less than IR greater than laid the groundwork for future efforts to unify reporting standards, culminating in recent moves by the IFRS Foundation. 4.4 ISSB, the turning point. In 2021, the IFRS Foundation launched the International Sustainability Standards Board, ISSB. This was a watershed moment. The same body that brought us IFRS financial standards would now create global ESG reporting standards. By consolidating SASB, CDSB, and aligning with TCFD, the ISSB aims to develop a baseline set of sustainability disclosure standards, focus on investor-relevant, financially material information, support connectivity between financial and ESG reports. This makes ISSB the bridge between IFRS and ESG, enabling consistent, comparable, and verifiable reporting across jurisdictions. 4.5 Key areas of convergence. 1. Climate-related disclosures. Climate risk is now a core component of both financial and ESG reporting. ISSB's IFRS S2 mirrors the TCFD structure and integrates climate into enterprise value assessments. 2. Materiality. While financial reporting focuses on financial materiality, sustainability reporting often emphasizes double materiality, impact on and by the company. ISSB adopts an enterprise value lens to unify the two perspectives. 3. Governance and risk management. Both IFRS and ESG frameworks stress the importance of board oversight, internal controls, and enterprise risk systems. ESG risks are now part of broader governance audits. 4. Metrics and KPIs. Companies are beginning to report ESG KPIs alongside financial ones. Examples include emissions per unit revenue, gender diversity on boards, and supply chain audit scores. 5. Digital reporting. XBRL, originally developed for financial data, is being extended to ESG disclosures, enabling machine-readable, comparable data. 4.6 Benefits of converged reporting. Investor confidence, clearer understanding of long-term risks and performance drivers. Operational efficiency, reduces duplication across multiple reporting frameworks. Regulatory readiness, aligns with incoming ESG disclosure mandates. Reputation and trust, builds stakeholder credibility. Capital access, attracts ESG-conscious investors and lenders. 4.7 Challenges in achieving integration. Data silos. ESG data often resides in separate systems or departments. Limited standardization. Despite progress, ESG metrics vary across sectors. Lack of assurance. Many ESG disclosures are unaudited or estimated. Cultural resistance. CFOs and finance teams may not see ESG as their domain. Skills gap. Need for upskilling in sustainability concepts within finance teams. Bridging these gaps will require collaboration across functions, investment in technology, and a shift in corporate culture toward holistic value creation. 4.8 The role of technology. Digital tools and platforms are helping to accelerate convergence by automating data collection and validation, linking ESG and financial KPIs, providing dashboards and scenario analysis, enabling real-time reporting, facilitating third-party assurance. As technology matures, integrated reporting will become more real-time, data-driven, and stakeholder-centric. 4.9 The road ahead. The convergence of IFRS and ESG reporting is not just a technical or regulatory trend, it reflects a redefinition of what value means in the 21st century. Financial performance is no longer the sole measure of success. Companies must now demonstrate how they contribute to people, planet, and prosperity, and prove it with evidence. As regulators, investors, and standard setters align around a common vision, the future points toward unified reporting frameworks, mandatory ESG disclosures globally, audit-grade ESG data, widespread adoption of ISSB standards, integrated thinking, embedded in corporate governance. 4.10 Conclusion. The convergence of financial and sustainability reporting is a transformative development for companies, regulators, and capital markets. It signals the end of siloed disclosures and the beginning of integrated accountability. In the next chapter, we'll explore the regulatory landscape, the policies, bodies, and frameworks shaping the ESG and IFRS compliance environment across regions. Chapter 5: The Regulatory Landscape, Global Bodies and Frameworks. 5.1 Introduction: A New Era of Accountability. As ESG issues move from boardroom discussions to balance sheets, regulators worldwide are crafting frameworks to enforce disclosure, transparency, and performance on sustainability metrics. These regulations are not just policy shifts. They represent a global alignment of economic, environmental, and ethical priorities. To understand the compliance landscape, we must examine the institutions, initiatives, and regional approaches shaping the future of financial and ESG reporting. 5.2 Key Global Regulatory and Standard-Setting Bodies. 1. IFRS Foundation and ISSB. IFRS Foundation oversees the development and governance of IFRS standards. ISSB, International Sustainability Standards Board, created in 2021 to develop global baseline sustainability disclosure standards. Standards issued: IFRS S1 General Sustainability Disclosures and IFRS S2 Climate-Related Disclosures. Objective: harmonize ESG reporting with financial relevance and investor-focused disclosures. 2. International Organization of Securities Commissions, IOSCO. Global Association of Securities Regulators from over 130 jurisdictions. Endorses ISSB standards and plays a critical role in promoting consistent ESG regulation across capital markets. 3. European Financial Reporting Advisory Group, EFRAG. Provides technical advice to the European Commission. Co-developer of the European Sustainability Reporting Standards, ESRS, under the Corporate Sustainability Reporting Directive, CSRD. 4. U.S. Securities and Exchange Commission, SEC. Issued proposed rules requiring climate-related risk disclosures. Mandates ESG data for investment products under the Investment Company Act. Focuses on materiality, assurance, and anti-greenwashing compliance. 5. Financial Stability Board, FSB. Created the Task Force on Climate-Related Financial Disclosures, TCFD, a foundational climate reporting framework now embedded in many regulatory systems. 5.3 Global Frameworks and Standards Influencing ESG Compliance. 1. TCFD, Task Force on Climate-Related Financial Disclosures. 4 pillars: governance, strategy, risk management, metrics, and targets. Required or recommended in jurisdictions like the UK, Japan, and New Zealand. Basis for IFRS S2. 2. GRI, Global Reporting Initiative. Focuses on impact materiality, how a company affects the environment and society. Widely used for sustainability and CSR reports. Complements investor-focused standards like ISSB. 3. SASB, Sustainability Accounting Standards Board. Industry-specific ESG metrics. Emphasizes financial materiality. Now part of the IFRS Foundation under the ISSB. 4. CDP, Carbon Disclosure Project. Non-profit that collects climate, water, and deforestation disclosures from companies. Supports investor access to ESG performance data. 5. SDGs, UN Sustainable Development Goals. 17 Global Goals for People and Planet. Used by companies as a voluntary alignment tool for sustainability strategy and reporting. 5.4 Regional Regulatory Developments. European Union. CSRD replaces Non-Financial Reporting Directive (NFRD) mandates detailed ESG disclosures aligned with ESRS. Applies to -50,000 companies, including non-EU firms with EU operations. Requires third-party assurance and double materiality. United States. SEC proposed rules require climate-related financial disclosures and Scope 1/2 GHG emissions. Department of Labor (DOL) allows ESG in retirement plan investment decisions. State-level laws, e.g., California's Climate Disclosure Law, add further complexity. United Kingdom. Mandatory TCFD aligned disclosures for listed and large private companies. Transition plans for net zero emissions required for certain sectors. Asia Pacific. Japan. Tokyo Stock Exchange mandates ESG disclosures under Corporate Governance Code. Singapore. ESG reporting mandatory for listed companies by 2025. China. Gradually increasing ESG expectations, especially for state-owned and listed firms. Africa and Middle East. South Africa. King IV Governance Code includes ESG principles. UAE and Saudi Arabia, moving toward ESG integration as part of economic diversification strategies. 5.5 The role of central banks and financial institutions. Network for Greening the Financial System, NGFS, coalition of central banks promoting climate risk integration into financial supervision. IMF and World Bank increasingly embed ESG conditions in lending and development programs. Private sector influence. Institutional investors, e.g., BlackRock, Vanguard, push for regulatory adoption and corporate ESG maturity. 5.6 Challenges in global ESG regulation. Fragmentation. Different jurisdictions use different frameworks and definitions. Compliance costs, particularly burdensome for SMEs and companies operating across multiple jurisdictions. Double versus single materiality. Regulatory philosophies vary, complicating convergence. Assurance and auditability, limited capacity and inconsistent audit standards for ESG disclosures. Political risk, ESG backlash in some jurisdictions, e.g., anti-ESG sentiment in parts of the U.S. 5.7 Trends shaping the regulatory future. Mandatory disclosures. ESG reporting is moving from voluntary to legally binding. Consolidation of frameworks. ISSB is streamlining overlapping standards. Integrated assurance models. ESG data will be held to the same audit standards as financial data. Cross-border coordination. IOSCO and IFRS Foundation aim to ensure global interoperability. Digital ESG taxonomies. Structured data formats, e.g., XBRL, to ensure comparability and automation. 5.8 What this means for companies. Companies must monitor, understand, and align with multiple ESG reporting requirements. Risk of non-compliance includes fines, reputational harm, and investor divestment. Early compliance offers strategic advantages, such as access to ESG funds, stakeholder trust, and operational resilience. 5.9 Preparing for the future, compliance strategies. Map your obligations. Understand reporting duties across all jurisdictions you operate in. Develop an ESG governance framework. Assign board and management responsibility. Invest in reporting infrastructure. Use technology to collect, consolidate, and verify ESG data. Train key staff. Equip finance, legal, and sustainability teams to manage evolving compliance demands. Engage with stakeholders. Anticipate expectations from investors, regulators, and communities. Align with ISSB standards. Build reporting systems with IFRS S1 and S2 at the core to ensure global readiness. 5.10 Conclusion. The regulatory landscape for ESG and financial disclosure is in a state of dynamic evolution. As jurisdictions enforce more stringent rules and stakeholders demand greater accountability, businesses must navigate a complex but increasingly harmonized global ecosystem. In the next chapter, we'll take a deep dive into the IFRS Sustainability Disclosure Standards, IFRS S1 and S2, which represent the cornerstone of future compliance and investor transparency. Chapter 6: IFRS S1 and S2, the core of sustainability disclosure. 6.1 Introduction: The birth of global sustainability standards. In 2023, the IFRS Foundation's International Sustainability Standards Board, ISSB, released two foundational sustainability standards. IFRS S1, General Requirements for Disclosure of Sustainability-Related Financial Information. IFRS S2, Climate-Related Disclosures. These standards aim to unify global ESG reporting with the same credibility and structure as financial reporting, offering investors a clear, consistent, and comparable view of sustainability risks and opportunities. 6.2 Why IFRS S1 and S2 matter. Prior to IFRS S1 and S2, the ESG landscape was fragmented. Companies were juggling overlapping frameworks, GRI, SASB, TCFD, CDP, with varying methodologies and inconsistent investor utility. IFRS S1 and S2 changed that by providing a baseline for global ESG disclosure, focusing on enterprise value relevance, aligning with existing frameworks, TCFD, SASB, CDSB, enabling assurance-ready, auditable sustainability reporting. These standards are designed to complement IFRS accounting standards, and for non-IFRS users, they still serve as globally recognized sustainability guidelines. 6.3 Overview of IFRS S1. Title: General Requirements for Disclosure of Sustainability-Related Financial Information. Purpose: to establish the core content of all sustainability reporting beyond climate. Key features. Scope: all sustainability-related risks and opportunities that affect enterprise value. Structure: based on TCFD's 4 pillars: governance, strategy, risk management, metrics, and targets. Time horizons: requires disclosures on short, medium, and long-term impacts. Connectivity: must connect sustainability reporting with financial statements. Industry-specific guidance: incorporates SASB standards to guide disclosures by sector. Disclosure requirements. Governance: oversight by the board or committees. Management's role in managing sustainability risks. Strategy: sustainability-related risks and opportunities. Impact on business model and value chain. Resilience analysis, e.g., climate scenarios. Risk management: identification, assessment, and mitigation of sustainability risks. Integration into enterprise risk processes. Metrics and targets. Quantitative and qualitative KPIs. Targets and performance tracking. Use of estimation and limitations. 6.4 Overview of IFRS S2. Title: Climate-Related Disclosures. Purpose: to set out specific climate-related disclosure requirements under IFRS S1's general principles. Key features. Fully aligned with the TCFD recommendations. Covers physical and transition climate risks. Requires disclosure of GHG emissions, scopes 1, 2, and 3. Encourages scenario analysis and resilience planning. Disclosure requirements. Governance: role of board and management in overseeing climate risks. Strategy: climate-related risks and opportunities. Time-bound targets and transition plans. Impact on value creation and strategy. Risk management. Integration into overall risk framework. Specific controls for climate risk. Metrics and targets. GHG emissions required for scopes 1 and 2, scope 3 encouraged. Internal carbon price. Climate performance targets and progress. Cross-references. IFRS S2 builds on SASB metrics and leverages external sources like GHG Protocol for emissions accounting. 6.5 Sector-specific application using SASB standards. IFRS S1 and S2 allow companies to use industry-specific standards to enhance relevance and comparability. The SASB standards, now under ISSB, provide tailored ESG metrics across 77 sectors. Examples: banking, loan exposure to fossil fuel industries; real estate, building energy use and emissions; consumer goods, supply chain labor practices. Companies are encouraged to align their disclosures with sector-specific sustainability factors that most materially affect enterprise value. 6.6 Interoperability with other frameworks. IFRS S1 and S2 are designed to work alongside other sustainability frameworks. This interoperability allows companies to use a single set of disclosures to satisfy multiple frameworks, especially when using the ISSB as the core. 6.7 Assurance and auditability. IFRS S1 and S2 emphasize verifiability of sustainability data. Encourages internal controls and third-party assurance. Promotes use of XBRL for structured digital disclosure. Helps align ESG data with existing audit and financial reporting infrastructure. Assurance-ready ESG data will become essential for investor confidence and regulatory compliance. 6.8 Implementation considerations. Companies should consider the following when adopting IFRS S1 and S2. Gap analysis. Compare existing ESG disclosures with S1, S2 requirements. Materiality assessment. Determine which sustainability risks affect enterprise value. Data collection systems. Set up or upgrade systems for GHG, energy, and risk data. Governance integration. Embed ESG oversight into board and risk management processes. Staff training. Build internal capacity across sustainability, finance, legal, and audit teams. External assurance. Engage with third-party reviewers to verify metrics and targets. 6.9 Global Adoption Outlook. Voluntary at first, IFRS S1 and S2 are being considered for regulatory endorsement in many jurisdictions. IOSCO has called on member regulators to adopt ISSB standards. Likely to be integrated into national ESG reporting rules in Asia Pacific, Latin America, Africa, and the Middle East. Viewed as a global baseline, enabling layering of jurisdiction-specific disclosures, e.g., EU CSRD, SEC rules on top. 6.10 Conclusion. IFRS S1 and S2 represent a seismic shift in global reporting. For the first time, sustainability disclosures are being standardized, regulated, and aligned with investor needs at the same level as financial information. Adoption of these standards will not only drive compliance, it will reshape how companies plan, govern, measure, and communicate value in the age of climate risk, social accountability, and transparent governance. Chapter 7. Implementing ESG Reporting Systems. 7.1 Introduction. From Intention to Execution. With ESG disclosure becoming a global norm, organizations must move from strategic commitment to operational capability. Implementing a robust ESG reporting system is no longer a nice-to-have, it is a critical business function akin to financial reporting. This chapter outlines how to build and operationalize ESG reporting processes that meet the requirements of IFRS S1 and S2, and how to ensure that these processes are integrated, reliable, and strategically useful. 7.2 Foundational Principles of ESG Reporting Systems. To build a sustainable ESG reporting system, companies must prioritize the following principles. Relevance. Focus on ESG factors material to enterprise value. Accuracy. Ensure data quality, reliability, and auditability. Comparability. Use standardized metrics, e.g., SASB, ISSB. Integration. Align ESG with financial and risk systems. Scalability. Ensure systems can grow with evolving regulations. 7.3 Step 1. Establish governance and accountability. Strong ESG reporting starts with leadership. Governance structure. Board oversight. Assign ESG responsibility to a board committee, e.g., audit, risk, sustainability. Executive sponsorship. Appoint a C-level leader, CFO, CSO, or CRO, to champion ESG. ESG working group. Cross-functional team, finance, legal, risk, HR operations, to coordinate implementation. Roles and responsibilities. Finance. Align ESG disclosures with financial reports. Legal and compliance. Interpret regulatory requirements. Sustainability. Manage data collection and strategy alignment. Enable system integration and data governance. 7.4 Step 2. Define material ESG topics. Materiality is the cornerstone of IFRS S1 and S2. Companies must focus on ESG issues that significantly affect their financial performance and enterprise value. Process. Identify potential ESG topics using SASB, TCFD, GRI, peer benchmarking. Conduct materiality assessments involving stakeholders, e.g., investors, customers, employees. Map material ESG topics to business functions, risks, and KPIs. Validate through governance. Present findings to board or audit committee. Example material topics by industry. 7.5 Step 3. Build the data architecture. ESG reporting is data intensive. Companies need a structured data ecosystem to support disclosures. Components of ESG data architecture. Data sources, IoT sensors, HR systems, ERP, supplier portals, surveys. Data collection tools, automated APIs, data lakes, ESG software. Data management, data quality checks, audit trails, version control. Metadata documentation, definitions, calculation methods, assumptions. Technology options. ESG platforms, e.g., Workiva, Sphera, Persephone, Invisi. Integration with ERP, e.g., SAP, Oracle, and finance systems. Cloud-based dashboards for real-time visibility and reporting. 7.6 Step 4. Develop and align metrics. Companies must align KPIs with IFRS S1, S2, and stakeholder expectations. Metrics categories. Target setting. Set time-bound targets, e.g., net zero by 2040. Align with science-based targets and TCFD or SBTi guidance. Include scenario planning and resilience assessments. 7.7 Step 5. Integrate ESG into core business processes. ESG cannot be an isolated function. It must be embedded into strategy, operations, and risk management. Key integration areas. Strategy planning. Use ESG data in scenario analysis and capital allocation. Enterprise risk management, include climate and social risks in risk registers. Budgeting. Allocate resources to meet ESG targets. Procurement. Embed ESG clauses in supplier contracts. Internal audit. Extend audit scope to include ESG controls. 7.8 Step 6. Prepare for assurance and external disclosure. IFRS standards are designed for auditable disclosures. Prepare accordingly. Steps for assurance readiness. Develop internal controls over ESG data collection and processing. Perform ESG pre-audits or mock audits. Engage external assurance providers early, e.g., Big Four sustainability consultants. Document data lineage and assumptions. Align with XBRL formatting for digital submission, where required. 7.9 Step 7. Communicate ESG performance. Once data is collected and verified, disclosures must be communicated in a way that meets regulatory and stakeholder needs. Disclosure channels. Sustainability report. Annual ESG narrative and performance summary. Integrated report. Combined financial plus ESG reporting. Regulatory filings. IFRS S1, S2 reports filed with authorities. Website disclosures. Real-time or quarterly ESG updates. Investor communications, earnings calls, investor briefings. Best practices. Use visual dashboards to present metrics. Explain context and trends, not just numbers. Clearly state limitations, uncertainties, and methodologies. Maintain reporting consistency year over year. 7.10 Challenges and Solutions. 7.11 Conclusion. Implementing ESG reporting systems is a multi-phase, cross-functional transformation. It requires investment in data, processes, governance, and culture. But those who build this foundation early will not only stay compliant, they'll enhance their strategic decision-making, risk management, and stakeholder trust. Chapter 8: ESG Assurance and Auditing. 8.1 Introduction: The Next Frontier in Corporate Assurance. As ESG data increasingly influences investor decisions, confidence in ESG disclosures is paramount. Just like financial statements are audited for accuracy and reliability, ESG disclosures are now entering the domain of assurance. The release of IFRS S1 and S2, designed to be auditable and decision-useful, accelerates the need for robust ESG assurance frameworks. This chapter unpacks the current landscape of ESG assurance, its challenges, and how organizations can build internal and external audit practices to support reliable, compliant sustainability reporting. 8.2 What is ESG assurance? ESG assurance is the independent evaluation of sustainability-related disclosures, processes, and controls to ensure their accuracy, completeness, and consistency with applicable standards or frameworks, e.g., IFRS S1, S2, GRI, SASB. There are two key forms. Limited assurance provides moderate confidence, more common and cost-effective. Reasonable assurance, comparable to financial audits, offers a high level of confidence and is more rigorous. 8.3 Why ESG assurance matters. Investor trust. Investors demand credible data to assess ESG risks and opportunities. Regulatory compliance. IFRS S1, S2 disclosures are increasingly subject to review by regulators and exchanges. Risk management. Assurance reduces reputational and legal risks from misstatements. Comparability. Promotes consistent ESG metrics across firms and sectors. A lack of assurance raises concerns over greenwashing, misreporting, or inconsistent ESG scoring by rating agencies. 8.4 Global Trends in ESG Assurance. 8.5 What auditors look for in ESG assurance. When performing ESG assurance, auditors evaluate data governance, ownership, documentation, and quality checks. Materiality alignment, whether disclosures match stakeholder and business relevance. Control environment, internal controls over data capture, aggregation, and reporting. Traceability, ability to follow data from source to disclosure, data lineage. Methodology, clear definitions, standards applied, assumptions used. Consistency, alignment with prior periods and external benchmarks. Estimation uncertainty, disclosure of ranges, models, and margins of error. 8.6 Internal audit and ESG. Internal audit functions play a pivotal role in ESG assurance, particularly in early-stage or first-line reviews. Roles of internal audit. Evaluate ESG data controls and processes. Review alignment of disclosures with IFRS S1, S2. Test accuracy of KPIs and GHG calculations. Assess readiness for external assurance. Advise on risk exposure from ESG misstatements. Example activities. Conduct walkthroughs of energy, water, HR, and supply chain data systems. Verify existence of climate scenario modeling. Ensure ESG metrics are integrated into frameworks. 8.7 External ESG assurance providers. External ESG assurance is typically conducted by traditional audit firms, Big Four, PwC, Deloitte, EY, KPMG. Benefit from experience in financial audits and control testing. Increasing ESG capacity with climate scientists, engineers, and sustainability experts. Specialist firms, e.g., Bureau Veritas, SGS, deep expertise in sustainability and environmental metrics. Often engaged for technical Scope 3 or supply chain audits. Hybrid approaches. Use financial auditors for governance metrics and specialists for technical verification, e.g., GHG emissions, biodiversity impact. 8.8 Frameworks and standards for assurance. To ensure consistency, many ESG assurance engagements follow these standards. As ESG becomes more embedded in enterprise value, new standards for reasonable assurance tailored to IFRS S1, S2 are expected from the IAASB and national audit standard setters. 8.9 Challenges in ESG assurance. 8.10 Preparing for ESG assurance, a step-by-step guide. Perform an ESG audit readiness assessment. Review systems, controls, and gaps with IFRS S1, S2 requirements. Document ESG policies and procedures. Include calculation methodologies, governance roles, and control checkpoints. Establish a data control framework. Automate validation rules and audit logs. Conduct trial audits. Engage internal audit or an external firm for a mock assurance. Engage with auditors early. Align on scope, level, limited versus reasonable, and key focus areas. Integrate ESG into annual audit planning. Coordinate ESG and financial audit cycles. 8.11 The future of ESG assurance. ESG assurance will evolve rapidly in the next 3 to 5 years. Mandatory reasonable assurance will be standard for large companies. Real-time digital assurance using AI, IoT, and blockchain will emerge. Integrated audits, financial plus ESG, will become common practice. Assurance of ESG narrative, e.g., transition plans, will increase. Global convergence of audit standards will align ESG with financial frameworks. 8.12 Conclusion. Assurance transforms ESG reporting from storytelling to evidence-backed accountability. It enhances the credibility of sustainability disclosures and helps organizations build resilience in a fast-changing regulatory and reputational environment. The move toward assurance of ESG under IFRS S1 and S2 is not only a compliance requirement, it's a strategic imperative for trusted, transparent business leadership. Chapter 9 ESG Disclosures for Investors. 9.1 Introduction. Speaking the language of capital. Investors are increasingly demanding decision-useful ESG disclosures, not generic sustainability narratives. IFRS S1 and S2 aim to bridge the gap between financial materiality and sustainability performance by requiring disclosures that help users understand how ESG factors affect an entity's enterprise value. This chapter explores how to tailor ESG communications to meet investor needs, enhance comparability, and comply with IFRS S1, S2 requirements. 9.2 Investor Priorities in ESG Reporting. Investors want ESG data that links to financial performance, is comparable across peers and sectors, is forward-looking with scenario analysis, reflects robust governance and risk management, shows clear metrics, targets, and progress. They are particularly interested in climate-related financial impacts, e.g., stranded assets, transition risk, social and governance performance in risk-prone sectors, ESG-related CapEx and OpEx trends, decarbonization plans, and credibility. 9.3 IFRS S1, S2 Disclosures, Investor Focus Framework. IFRS sustainability standards emphasize enterprise value relevance, disclosures that impact cash flows, capital access, and valuation. Core requirements under IFRS S1. Governance over sustainability risks and opportunities. Strategy for managing these issues. Risk management systems in place. Metrics and targets, including KPIs. Linkages to financial statements. Additions under IFRS S2 Climate. Climate-related scenario analysis. GHG emissions scopes 1, 2, and 3. Transition plan and net zero commitments. Climate risk resilience analysis. 9.4 Key disclosure elements and formats. IFRS encourages the use of XBRL tagging for digital disclosures to improve comparability. 9.5 Crafting ESG disclosures for analyst and investor calls. Disclosures are not limited to published reports. Key ESG narratives should be reinforced during earnings calls. Connect ESG risks to financial performance or outlook. Investor days, present scenario analysis and transition plans. Annual general meetings, AGMs, disclose ESG strategy and performance updates. Investor call talking points. ESG performance versus targets. Climate risk impacts on valuation or operations. CapEx allocation for sustainability initiatives. Regulatory developments, e.g., CBAM, IFRS. 9.6 ESG metrics that matter to investors. Investors' preferred decision useful ratios. Emissions per revenue. ESG adjusted ROI. ESG risk adjusted capital allocation. 9.7 Common pitfalls in investor ESG communication. 9.8 Integrated reporting. The future of ESG communication. Many leading organizations are moving toward integrated reporting, where financial and sustainability information is presented in a single, cohesive narrative. Benefits. Aligns ESG with strategy, risk, and performance. Builds investor confidence. Enhances regulatory readiness. Reduces duplication of efforts. Integrated reports often follow the IIRC Integrated Reporting Framework, now aligned with IFRS Foundation objectives. 9.9 Role of ratings, indices, and ESG funds. Disclosures are often used by ESG rating agencies, e.g., MSCI, S&P Global Sustainalytics. ESG indices, e.g., DJSI, FTSE4Good. Sustainable investment funds. How disclosures impact investor perception. Poor disclosure, right pointing arrow, lower ESG ratings, right pointing arrow, exclusion from ESG funds. Transparent, assured data, right pointing arrow, improved index inclusion, and capital access. Companies should engage with ESG raters and review scoring criteria to ensure disclosures address material factors. 9.10 Best practices in investor ESG communication. Tailor disclosures to investor personas, e.g., impact funds, asset managers, analysts. Use investor-relevant metrics, link ESG to performance, risk, and value drivers. Provide consistent reporting over time to enable trend analysis. Align with financial disclosures to avoid contradictions. Maintain a centralized ESG data portal or investor page. 9.11 Case study, ESG disclosure in practice, a utilities company. Scenario. A European energy utility adopts IFRS S1 and S2 and issues a climate-focused investor report. Key disclosures. Scope 1 and 2 emissions down 15% YoY. 3.2 billion euros allocated to renewable CapEx over 3 years. Scenario analysis, 1.5 degrees Celsius and 3 degrees Celsius transition risks. Net zero target by 2045, clear milestones. Climate-adjusted earnings, presented alongside financial metrics. Investor response, increased institutional investor support and improved ESG ratings. 9.12 Conclusion. Investors are no longer passive consumers of sustainability data. They are active users demanding financial-grade ESG disclosures. IFRS S1 and S2 give organizations the tools and framework to meet these expectations with clarity, credibility, and comparability. Firms that align their ESG reporting with investor needs and global standards will gain access to new capital, build trust, and position themselves for long-term value creation. Chapter 10: Industry-Specific ESG and IFRS Compliance. 10.1 Introduction: One size does not fit all. While IFRS sustainability disclosure standards provide a common framework, industry context profoundly influences ESG risks, materiality, and reporting priorities. Different sectors have distinct environmental impacts, social considerations, and governance challenges that require customized compliance strategies. This chapter examines key sectors: finance, energy, manufacturing, technology, and retail, and explores best practices for aligning IFRS ESG disclosures with sector-specific realities. 10.2 Financial Services. Key ESG risks: climate-related credit and investment risks, data privacy and cybersecurity, diversity and inclusion in workforce and leadership, responsible lending and social impact. IFRS S1 S2 Compliance Focus. Disclosure of climate risk stress testing on loan portfolios. Integration of ESG risk in credit risk models. Reporting on governance policies and ethics frameworks. Social risk metrics, e.g., community investments, customer privacy breaches. Best practices. Develop scenario analyses for credit exposure under different climate pathways. Align ESG KPIs with financial risk disclosures, e.g., loan loss provisions. Engage with regulators on evolving sustainability risk guidelines. 10.3 Energy and Utilities. Key ESG risks: GHG emissions and transition to renewables, water usage and biodiversity impact, worker safety and community relations, regulatory compliance in multiple jurisdictions. IFRS S1 S2 Compliance Focus. Full disclosure of Scope 1, 2, and 3 emissions. Transparent transition plans with milestones. Resilience of assets under climate scenarios, physical risks. Energy efficiency and renewable energy targets. Best practices. Use technology-enabled data collection, e.g., IoT sensors for emissions. Regular third-party assurance of emissions and environmental data. Communicate investment in green infrastructure and divestment from fossil fuels. 10.4 Manufacturing and Industrial. Key ESG risks: resource use and waste management, occupational health and safety, supply chain labor practices and human rights, product lifecycle impacts and circular economy. IFRS S1 S2 Compliance Focus. Quantify energy and water intensity per unit of output. Report workplace incident rates and safety programs. Disclose supplier due diligence and remediation efforts. Highlight initiatives on product sustainability and recycling. Best practices. Integrate ESG metrics into operational KPIs. Collaborate with suppliers to improve data accuracy and compliance. Adopt environmental management systems, e.g., ISO 14001. 10.5 Technology Sector. Key ESG risks: data privacy and security, ethical AI and automation impacts, energy consumption in data centers, workforce diversity and labor standards. IFRS S1 S2 Compliance Focus. Reporting on data breach incidents and cybersecurity investments. Disclosure of energy use and carbon footprint of IT infrastructure. Social metrics on diversity and inclusion. Governance of AI ethics and product responsibility. Best practices. Implement robust privacy and ethics policies. Use renewable energy for data centers and disclose progress. Promote transparent communication on algorithmic fairness. 10.6 Retail and Consumer Goods. Key ESG risks: supply chain sustainability and human rights, packaging waste and circular economy, labor conditions and fair wages, product safety, and customer health. IFRS S1 S2 compliance focus. Supply chain risk mapping and disclosure. Packaging reduction targets and waste diversion metrics. Labor standards monitoring and supplier audits. Customer product safety incidents and recalls. Best practices. Engage suppliers in capacity building and compliance training. Set ambitious plastic and waste reduction targets. Report transparently on social audits and corrective actions. 10.7 Cross-industry ESG themes. Regardless of sector, some ESG topics require consistent treatment. Climate change, GHG emissions, physical and transition risks. Governance, board diversity, executive compensation linked to ESG. Human rights, across operations and supply chains. Data quality, assurance, audit and controls. 10.8 Tailoring IFRS disclosures. Companies should apply a materiality lens that factors in sector-specific risks and opportunities, stakeholder expectations, regulatory environment, market positioning, and strategic priorities. 10.9 Conclusion. Effective ESG compliance under IFRS S1 and S2 demands sector-aware reporting strategies. By understanding industry-specific risks and adopting tailored disclosures, organizations can better meet investor needs, enhance transparency, and build sustainable competitive advantages. Chapter 11. Technology and Tools for IFRS ESG Compliance. 11.1 Introduction. The digital backbone of ESG reporting. As ESG reporting requirements become more rigorous and standardized under IFRS sustainability disclosure standards, technology plays a critical role in enabling organizations to meet compliance efficiently and accurately. Robust tools and platforms help collect large volumes of data across operations and supply chains, ensure data quality, facilitate assurance, and produce investor-grade disclosures. This chapter explores key technologies and digital strategies for ESG data management and reporting. 11.2 ESG Data Management Systems. A foundational element is an enterprise ESG data management system, EDMS, that centralizes data collection, validation, and reporting. Core features: automated data ingestion from sensors, ERPs, and external databases. Workflow management for data approval and corrections. Audit trails to ensure data lineage and traceability. Integration with financial reporting systems for coherence. Popular solutions: SAP Sustainability Control Tower, Workiva ESG Reporting Platform, IBM Environmental Intelligence Suite. 11.3 Data Collection Technologies. ESG data often originates from diverse sources, necessitating advanced collection methods. IoT sensors, real-time monitoring of energy, water, emissions, and waste. Blockchain, immutable records for supply chain traceability and carbon credits. Satellite imaging and drones, for environmental monitoring, deforestation, pollution. Mobile apps, field data entry for social audits and safety inspections. 11.4 Data Analytics and AI in ESG. Advanced analytics and AI enable deeper insights and predictive capabilities. Materiality assessment tools, using AI to scan external data, news, and regulations to identify emerging ESG risks. Scenario modeling, simulating climate impacts on assets and financial outcomes. Natural language processing, NLP, analyzing text-based disclosures for consistency and gaps. Anomaly detection, flagging unusual ESG data points that may require review. 11.5 Digital reporting and disclosure platforms. Generating disclosures aligned with IFRS S1, S2 demands structured, accessible reporting platforms. Support for XBRL tagging of ESG data to meet digital filing requirements. Dashboards for real-time ESG KPI monitoring. collaboration portals for cross-functional teams and external assurance providers. Automated generation of sustainability reports, integrated reports, and regulatory filings. 11.6 Integration with financial systems. ESG data must align with financial results to support enterprise value disclosure. Linking ESG KPIs to financial metrics, e.g., carbon cost impact on EBITDA. Integrating ESG risks into enterprise risk management, platforms. Embedding ESG considerations into budgeting and capital allocation tools. 11.7 Emerging technologies impacting ESG compliance. 11.8 Challenges in technology adoption. Data silos. Disconnected systems impede comprehensive ESG data views. Data quality. Inconsistent formats and unstructured data pose risks. Cost and complexity. Technology investments can be expensive for SMEs. Cybersecurity risks. Sensitive ESG and financial data must be protected. 11.9 Building a technology roadmap for ESG compliance. Steps for organizations. Assess current capabilities. Identify gaps in ESG data and reporting systems. Define requirements. Align technology needs with IFRS S1, S2, and internal goals. Select scalable solutions. Prioritize platforms with integration and assurance capabilities. Pilot and iterate. Test tools and key operations before full rollout. Train teams. Ensure staff understand systems and data governance. Engage assurance providers. Incorporate their needs into system design. 11.10 Case study. Digital transformation for ESG compliance. A multinational manufacturing firm implemented an integrated ESG data platform, linking IoT sensors, ERP systems, and reporting software. This enabled real-time emissions tracking across plants, automated data validation, and audit trails. Seamless generation of IFRS-aligned ESG disclosures. Improved internal controls facilitating external assurance. The result: reduced reporting time by 40%, enhanced data accuracy, and increased investor confidence. 11.11 Conclusion. Technology is a powerful enabler of efficient, reliable, and transparent ESG reporting under IFRS standards. By investing strategically in data management, analytics, and reporting tools, organizations can meet compliance demands, support assurance, and unlock new insights to drive sustainable business performance. Chapter 12: Governance and Internal Controls for ESG Compliance. 12.1 Introduction: The Foundation of Credible ESG Reporting. Effective governance and robust internal controls form the backbone of trustworthy ESG disclosures. As sustainability reporting evolves from voluntary disclosure to mandated IFRS standards compliance, companies must embed ESG oversight within their corporate governance structures and risk management processes. This chapter explores how governance bodies, policies, and control mechanisms support ESG compliance and investor confidence. 12.2 ESG Governance Structures. Board-level oversight. Boards increasingly establish dedicated ESG committees or integrate ESG oversight into existing audit or risk committees. Responsibilities include reviewing ESG strategy and risk management, approving sustainability targets and disclosures, engaging with investors on ESG matters, management, accountability. ESG responsibilities should be clearly assigned to senior executives, often a Chief Sustainability Officer, CSO, or equivalent. Cross-functional teams spanning finance, compliance, operations, and communications collaborate to gather and verify ESG data. 12.3 Internal Controls Framework for ESG. Robust internal controls ensure data accuracy, completeness, and reliability for ESG disclosures. Key control elements include policies and procedures, formal documentation outlining data collection, processing, and reporting steps. Segregation of duties, separating roles to prevent errors and fraud. Data validation and reconciliation, comparing ESG data against operational records and third-party sources. It controls, ensuring system security, access controls, and audit trails for ESG data platforms. Regular monitoring and reviews, ongoing checks to identify anomalies or inconsistencies. 12.4 Integrating ESG controls with financial reporting controls. Because IFRS S1, S2 emphasize ESG factors' impact on enterprise value, controls should be integrated with financial reporting processes. Link ESG data validation with financial close procedures. Ensure disclosures are consistent across sustainability and financial reports. Include ESG risks in enterprise risk management frameworks. 12.5 Assurance and external verification. External assurance strengthens disclosure credibility. Types of assurance. Limited or reasonable assurance over ESG metrics. Third-party verification of emissions data. Assurance providers. Accounting firms, specialized ESG auditors, or independent consultants. Preparation for assurance. Implement internal controls aligned with assurance scope. Maintain detailed documentation and evidence trails. 12.6 Regulatory and compliance considerations. Stay updated on evolving ESG regulatory requirements in jurisdictions of operation. Ensure governance frameworks meet both local regulations and global IFRS standards. Maintain transparency with regulators and stakeholders on ESG governance practices. 12.7 Best practices in ESG governance and controls. 12.8 Case study, strengthening ESG governance in a global retailer. A global retailer revamped its ESG governance by creating a board ESG committee with quarterly reporting, appointing a chief sustainability officer, reporting directly to the CEO, establishing a cross-department ESG data working group, implementing a centralized ESG data management system with strong access controls, engaging external auditors for limited assurance on carbon emissions and labor standards data. Result: improved disclosure reliability, positive stakeholder feedback, and alignment with IFRS compliance expectations. 12.9 Conclusion. Strong governance and internal controls are indispensable for credible IFRS-aligned ESG disclosures. Organizations that prioritize governance frameworks not only comply effectively, but also build lasting trust with investors and stakeholders, reinforcing their commitment to sustainable value creation. Chapter 13. Assurance and verification of ESG disclosures. 13.1 Introduction: Why assurance matters. As ESG disclosures become mandatory under IFRS S1 and S2, stakeholders increasingly expect these reports to be assured or verified to ensure accuracy, completeness, and reliability. Assurance enhances trust with investors, regulators, and the public by providing independent validation that ESG information is free from material misstatements. This chapter explores assurance types, methodologies, standards, and best practices. 13.2 Types of ESG assurance. Limited assurance. Provides moderate confidence that ESG disclosures do not contain material misstatements. Common in initial ESG assurance engagements. Involves inquiry, analytical procedures, and limited testing. Reasonable assurance. Offers a higher level of confidence similar to financial audits. Requires extensive testing, evidence gathering, and evaluation. More rigorous and costly than limited assurance. 13.3 Assurance standards and frameworks. Key standards guiding ESG assurance include ISA E3000 Revised, International Standard for Assurance Engagements other than audits or reviews of historical financial information. AA1000 Assurance Standard, AA1000 AS, focuses on stakeholder inclusiveness, materiality, and responsiveness. ISA E3410, specifically for greenhouse gas statements. National standards vary by jurisdiction, e.g., PCAOB in the US, FRC in the UK. 13.4 Scope of ESG assurance. Assurance engagements may cover quantitative data, emissions, water use, energy consumption. Qualitative information, governance policies, risk management disclosures. Process controls, data collection, aggregation, and reporting systems. Third-party data, supplier ESG data, external ratings. Organizations must clearly define the assurance scope to align expectations. 13.5 The assurance process. Planning, understand the company's ESG reporting processes and risks. Risk assessment, identify areas with higher risk of misstatement or omission. Testing, perform procedures on data and controls, including site visits. Evaluation, assess findings against materiality thresholds. Reporting, issue an assurance statement detailing scope, methodology, and conclusions. 13.6 Challenges in ESG assurance. Data complexity, diverse sources and formats complicate validation. Lack of historical data makes trend analysis and benchmarking difficult. Subjectivity, some ESG topics are qualitative or forward-looking. Assurance provider expertise. ESG assurance requires multidisciplinary knowledge. Cost and resource constraints, especially for SMEs. 13.7 Enhancing assurance readiness. To prepare for assurance engagements, organizations should develop standardized ESG data collection and validation procedures. Implement internal controls and audit trails. Train staff involved in ESG reporting and data management. Engage assurance providers early in the reporting cycle. Use technology tools to improve data accuracy and traceability. 13.8 Assurance reporting and communication. Assurance statements should be clear and understandable for stakeholders. Include scope, criteria, methodology, and limitations. Highlight any material findings or areas for improvement. Published alongside ESG disclosures for transparency. 13.9 Case study. Assurance of climate-related disclosures in a mining company. A large mining company obtained reasonable assurance over its greenhouse gas emissions and climate risk disclosures. The assurance provider verified data collection systems across multiple sites, tested emissions calculations and third-party verification of Scope 3 data, reviewed scenario analyses for physical and transition risks, recommended improvements in data governance and supplier data integration. The assured report increased investor confidence and helped the company meet regulatory expectations. 13.10 Conclusion. Assurance of ESG disclosures is essential for meeting IFRS standards and building stakeholder trust. While challenges remain, a systematic approach to assurance readiness, combined with collaboration between companies and assurance providers, strengthens the reliability and impact of sustainability reporting. Chapter 14. Emerging Trends in ESG Regulation and IFRS Standards. 14.1 Introduction. A dynamic ESG regulatory environment. The ESG reporting landscape is rapidly evolving. Regulators, standard setters, investors, and stakeholders worldwide are increasingly demanding transparent, comparable, and decision-useful ESG information. IFRS Sustainability Disclosure Standards, S1 and S2, are part of a broader movement toward global ESG harmonization, but new challenges and trends continue to emerge. This chapter highlights the major trends influencing ESG regulation and IFRS standard setting. 14.2 Global Convergence and Standardization. IFRS Foundation's role. The International Sustainability Standards Board, ISSB, is spearheading global efforts to harmonize ESG reporting through the IFRS S1 and S2 standards, aiming to create a global baseline. Alignment with other frameworks. Efforts continue to align IFRS standards with frameworks like the Task Force on Climate-Related Financial Disclosures, TCFD, the Sustainability Accounting Standards Board, SASB, and the EU's Corporate Sustainability Reporting Directive, CSRD. Cross-jurisdictional coordination. Regulatory agencies are collaborating to minimize duplication and conflicting requirements for multinational companies. 14.3 Expansion of ESG topics covered. The scope of ESG disclosures is broadening beyond climate to include biodiversity, water stewardship, human capital, social equity, and governance transparency. IFRS is expected to expand standards or introduce modules addressing emerging areas like nature-related risks and impacts, social and human rights issues, cybersecurity, and data privacy. Supply chain sustainability. 14.4 Increased regulatory mandates. Jurisdictions worldwide are moving from voluntary to mandatory ESG reporting with enforcement mechanisms. Examples: the European Union's CSRD and taxonomy regulation. The U.S. Securities and Exchange Commission, SEC, proposed rules on climate disclosures. The UK's Streamlined Energy and Carbon Reporting, SECR. Organizations must monitor regulatory developments continuously and adapt compliance strategies accordingly. 14.5 Advances in technology and data. Adoption of digital reporting standards, such as XBRL for ESG data tagging, is becoming standard practice. Use of blockchain and AI for data verification and enhanced assurance. Increasing reliance on real-time ESG data and continuous disclosure models. Technologies enable improved transparency, but also raise data privacy and cybersecurity considerations. 14.6 Investor and stakeholder expectations. Investors demand greater ESG transparency linked directly to enterprise value and financial performance. Growing focus on ESG outcomes and impact measurement, not just processes. Heightened scrutiny on greenwashing and quality of ESG disclosures. Calls for more inclusive reporting, reflecting diverse stakeholder interests. 14.7 Challenges ahead. Balancing standardization with flexibility to accommodate industry and regional differences. Managing data complexity and comparability amid expanding disclosure requirements. Ensuring capacity building within organizations, especially SMEs. Addressing costs and resource constraints for comprehensive ESG compliance. 14.8 Preparing for future compliance. Organizations should establish adaptive ESG governance frameworks. Invest in scalable technology and data management solutions. Engage proactively with regulators and standard setters. Focus on continuous improvement and staff training. Align sustainability strategy closely with business strategy and financial reporting. 14.9 Conclusion. The ESG regulatory and reporting environment will continue to evolve rapidly, driven by investor demand, societal expectations, and regulatory mandates. The IFRS sustainability disclosure standards provide a strong foundation, but organizations must remain agile and forward-looking to navigate emerging trends and maintain compliance. Chapter 15. Practical steps for implementing IFRS ESG compliance in your organization. 15.1 Introduction, From Standards to Action. Adopting IFRS S1 and S2 for ESG reporting requires more than understanding the standards. It demands practical organization-wide implementation. This chapter offers a roadmap to help companies translate IFRS ESG requirements into effective processes, systems, and culture. 15.2 Step 1. Establish governance and leadership commitment. Secure board-level sponsorship for ESG initiatives. Assign clear responsibilities to senior management and relevant departments. Set up or empower an ESG steering committee for cross-functional coordination. Embed ESG compliance into corporate governance policies and risk frameworks. 15.3 Step 2. Conduct a materiality assessment. Identify ESG topics that are material to your organization and stakeholders. Use a combination of stakeholder engagement, industry benchmarking, and risk analysis. Prioritize disclosures based on financial and impact materiality per IFRS guidelines. Document and regularly update the materiality matrix. 15.4 Step 3. Develop data collection and management processes. Map all data sources required for ESG disclosures. Implement or upgrade data management systems for accuracy and traceability. Define clear protocols for data ownership, verification, and updates. Integrate ESG data processes with financial reporting systems where possible. 15.5 Step 4. Build internal controls and assurance readiness. Develop policies and procedures for ESG data controls. Train employees on data integrity and reporting standards. Engage with internal audit and prepare for external assurance. Maintain documentation and evidence to support disclosures. 15.6 Step 5. Prepare and validate ESG disclosures. Draft disclosures aligned with IFRS S1 and S2 requirements. Review for consistency, completeness, and clarity. Use technology tools to facilitate disclosure compilation and formatting. Obtain internal and external reviews before finalizing reports. 15.7 Step 6. Communicate and engage with stakeholders. Publish ESG disclosures transparently in annual reports, sustainability reports, or standalone documents. Use digital platforms and interactive tools to enhance accessibility. Engage investors, customers, employees, and regulators proactively. Incorporate feedback into continuous improvement cycles. 15.8 Step 7. Monitor, review, and improve. Establish key performance indicators, KPIs, to track ESG performance and disclosure quality. Conduct periodic internal audits and governance reviews. Stay updated with evolving IFRS standards and regulatory requirements. Foster a culture of continuous learning and adaptation. 15.9 Step 8. Leverage technology and innovation. Invest in ESG data platforms, analytics, and reporting tools. Explore emerging technologies like AI, blockchain, and IoT to enhance data accuracy and transparency. Use scenario modeling and risk analytics to inform strategic decisions. Automate routine data collection and validation tasks to improve efficiency. 15.10 Conclusion. Implementing IFRS ESG compliance is a journey requiring strong leadership, cross-functional collaboration, robust systems, and continuous improvement. By following these practical steps, organizations can not only comply with IFRS standards, but also drive sustainable value creation and build trust with their stakeholders. Chapter 16. Case Studies in Successful IFRS ESG Compliance. 16.1 Introduction, Learning from Leaders. Practical implementation of IFRS ESG standards can be complex, but many organizations have navigated these challenges successfully. Examining their journeys provides valuable insights into best practices, common pitfalls, and innovative solutions. This chapter highlights diverse case studies, demonstrating how companies have embedded ESG into their governance, data management, reporting, and stakeholder engagement. 16.2 Case Study 1. Global Energy Company, Integrating Climate Disclosures. Background: a multinational energy company sought to align its sustainability reporting with IFRS S2's climate-related disclosure requirements. Actions taken: conducted a comprehensive climate risk assessment, including physical and transition risks. Integrated climate data with financial risk models. Established a cross-functional team including finance, sustainability, and risk management. Adopted advanced scenario analysis tools to project impacts under different climate pathways. Engaged third-party assurance on greenhouse gas emissions and climate disclosures. Results: enhanced transparency and credibility of climate-related disclosures. Improve strategic decision-making by incorporating climate risks into capital allocation. Positive investor feedback and alignment with emerging regulatory frameworks. 16.3 Case Study 2. Retailer enhancing social and governance reporting. Background: a large retail chain aimed to strengthen disclosures on labor practices, diversity, and governance to comply with IFRS S1. Actions taken: conducted a materiality assessment focusing on social and governance issues. Developed new data collection processes across its supply chain. Established an ESG committee at the board level. Implemented internal controls to verify social data and governance disclosures. Published an integrated report combining financial and ESG information. Results: increased stakeholder trust and improved supplier relationships. Better risk management related to labor practices and governance. Recognition in ESG ratings and indices. 16.4 Case Study 3. Financial institution leveraging technology for ESG reporting. Background: a global bank wanted to streamline ESG data collection and reporting to meet IFRS requirements efficiently. Actions taken: invested in an enterprise ESG data management system. Integrated ESG metrics into existing financial reporting platforms. Automated data validation and reconciliation processes. Used AI-driven analytics to identify ESG risk exposures. Engaged assurance providers early in the reporting cycle. Results: reduced reporting cycle time by 30%. Improved data accuracy and auditability. Enhanced ability to respond quickly to regulatory changes. 16.5 Case Study 4. Manufacturing company building governance for ESG. Background: a mid-size manufacturing firm lacked formal ESG governance and struggled with data reliability. Actions taken: established board-level ESG oversight with regular reporting. Assigned a chief sustainability officer. Created policies and procedures for ESG data governance. Implemented training programs for employees involved in ESG reporting. Developed internal audit processes for ESG disclosures. Results: strengthened internal controls and reporting accuracy. Fostered a culture of sustainability across operations. Improved stakeholder engagement and compliance readiness. 16.6 Lessons learned across case studies. 16.7 Conclusion. These case studies demonstrate that successful IFRS ESG compliance depends on integrated approaches tailored to organizational contexts. Whether through climate risk management, social governance enhancement, technology investments, or governance reforms, organizations can meet IFRS requirements while advancing their sustainability journeys. Chapter 17: The Future of ESG Reporting and IFRS Standards. 17.1 Introduction: Navigating an Evolving Landscape. ESG reporting is at a transformative crossroads, shaped by technological innovation, regulatory momentum, and growing stakeholder demand for transparency and impact. As IFRS sustainability disclosure standards continue to mature, companies must anticipate and adapt to the future landscape of ESG compliance. 17.2 Anticipated developments in IFRS ESG standards. Expansion of topics. New modules addressing biodiversity, human rights, cybersecurity, and social equity are expected. Greater integration. IFRS plans to deepen integration between financial disclosures and sustainability information, emphasizing value creation and risk management. Dynamic reporting requirements. More frequent and real-time disclosures enabled by digital technology. Enhanced guidance on materiality. refining the definitions and application of financial and impact materiality to improve comparability. 17.3 Technological innovation, shaping ESG reporting. Digital reporting platforms. Adoption of XBRL and similar tagging systems for machine-readable ESG data. Artificial intelligence and big data. For predictive analytics, risk identification, and automated assurance processes. Blockchain, providing immutable records to enhance data integrity and traceability. Internet of Things, IoT, enabling real-time environmental monitoring and performance tracking. 17.4 Evolving stakeholder expectations. Increasing demand for verified, high-quality ESG data directly linked to financial performance. A shift from compliance-focused reporting to demonstrating ESG impact and outcomes. Greater emphasis on social justice, equity, and inclusion in ESG disclosures. Rising expectations for companies to address global challenges, such as climate change and biodiversity loss transparently. 17.5 Challenges and opportunities ahead. Balancing global standards with local contexts, maintaining standardization while allowing regional adaptability. Ensuring data security and privacy, protecting sensitive ESG data in digital environments. Capacity building, developing ESG expertise across all levels of organizations. Addressing greenwashing, strengthening assurance, regulation, and stakeholder scrutiny. 17.6 Strategic imperatives for organizations. Foster a culture of innovation and agility in ESG reporting. Invest in advanced data and reporting technologies. Engage proactively with standard setters, regulators, and stakeholders. Align ESG strategy with broader business objectives and risk management. Prioritize transparency, accountability, and impact in all disclosures. 17.7 Conclusion. The future of ESG reporting and IFRS standards promises greater rigor, relevance, and responsiveness to global sustainability challenges. Organizations that anticipate these trends and embed ESG into their core strategies will be best positioned to thrive in the evolving landscape of sustainable business. Chapter 18. Integrating ESG into corporate strategy and risk management. 18.1 Introduction. From reporting to strategic integration. While ESG disclosure compliance is essential, the greatest value comes from embedding ESG principles directly into corporate strategy and risk management. This integration ensures sustainability factors drive decision-making, operational resilience, and competitive advantage. 18.2 ESG as a strategic imperative. ESG issues increasingly influence market positioning, brand reputation, and stakeholder trust. Aligning ESG with corporate strategy helps organizations anticipate trends, innovate, and meet evolving regulatory and investor demands. The IFRS sustainability disclosure standards encourage linking ESG disclosures to enterprise value, making strategic integration critical. 18.3 Identifying ESG-related risks and opportunities. Conduct comprehensive ESG risk assessments covering environmental, social, and governance dimensions. Use tools like scenario analysis and stress testing to evaluate potential impacts on business models. Identify ESG opportunities such as resource efficiency, new markets, and innovation. 18.4 Embedding ESG in strategic planning. Include ESG criteria in business objectives, investment decisions, and capital allocation. Develop sustainability goals and KPIs aligned with strategic priorities. Integrate ESG into M&A due diligence and partnership evaluations. Engage leadership and stakeholders to foster alignment and accountability. 18.5 ESG in enterprise risk management (ERM). Integrate ESG risks within the framework for holistic risk oversight. Establish risk appetite statements that incorporate ESG thresholds. Use ESG risk data to inform risk mitigation plans and controls. Report ESG risks regularly to the board and risk committees. 18.6 Measuring and monitoring ESG performance. Define clear, measurable ESG targets with timelines. Implement systems for continuous monitoring and reporting. Use ESG performance data to refine strategy and operations. Benchmark performance against peers and global standards. 18.7 Case study. Technology company aligning ESG with growth strategy. A global technology firm integrated ESG into its strategic roadmap by prioritizing energy efficiency and carbon neutrality in product design, embedding diversity and inclusion targets into talent management, linking executive compensation to ESG performance metrics, incorporating ESG risk scenarios into financial forecasting. Result: the company enhanced innovation, improved stakeholder relations, and mitigated emerging risks effectively. 18.8 Benefits of ESG integration. 18.9 Conclusion. Integrating ESG into corporate strategy and risk management transforms compliance into a competitive advantage. Companies that align sustainability with core business objectives are better equipped to navigate complexity, capitalize on opportunities, and deliver lasting value in a changing world. Chapter 19: ESG Reporting Tools and Technologies. 19.1 Introduction: The role of technology in ESG reporting. The complexity and volume of ESG data require sophisticated tools and technologies to collect, manage, analyze, and report information effectively. Leveraging technology helps organizations comply with IFRS sustainability disclosure standards while improving data accuracy, timeliness, and stakeholder engagement. 19.2 ESG Data Management Systems. Enterprise ESG platforms, integrated solutions that centralize ESG data collection, validation, and reporting. Features often include workflow automation, audit trails, user access controls, and customizable dashboards. Examples: Workiva, SAP Sustainability Control Tower, and Enablon. 19.3 Data Collection and Integration Tools. Tools that facilitate automated data capture from multiple sources, such as energy meters, supply chain databases, and financial systems. Use of APIs and IoT devices for real-time environmental monitoring. Integration with existing ERP and financial reporting systems for seamless data flow. 19.4 Analytics and Visualization. Advanced analytics platforms using AI and machine learning to identify trends, forecast ESG risks, and assess impact. Data visualization tools that present ESG metrics in accessible formats for diverse stakeholders. Scenario modeling to evaluate potential outcomes under various sustainability pathways. 19.5 Digital Reporting and Disclosure. Adoption of XBRL, Extensible Business Reporting Language, for tagging ESG data, enabling machine-readable and comparable disclosures. Platforms facilitating submission of ESG reports to regulators and exchanges. Use of blockchain for transparent and tamper-proof ESG reporting. 19.6 Assurance Technology. Technologies that support internal and external assurance processes by automating data validation and providing audit trails. AI-driven anomaly detection to flag inconsistencies. Digital platforms to manage assurance workflows and documentation. 19.7 Challenges in implementing ESG technologies. High initial investment and integration complexity. Data privacy and cybersecurity concerns. Need for staff training and change management. Ensuring technology solutions align with evolving IFRS standards and regulatory requirements. 19.8 Best Practices for Technology Adoption. Conduct a needs assessment aligned with ESG strategy and reporting requirements. Select scalable and flexible solutions that can evolve with the organization. Foster collaboration between ESG, finance, and audit teams. Prioritize user-friendly interfaces and robust data governance features. Plan for ongoing maintenance, updates, and training. 19.9 Conclusion. Technology is a critical enabler for effective IFRS ESG compliance, enhancing data quality, reporting efficiency, and transparency. Organizations that strategically adopt and integrate ESG reporting tools position themselves for sustainable success in an increasingly data-driven world. Chapter 20: Training and Capacity Building for IFRS ESG Compliance. 20.1 Introduction: The Human Element in ESG Compliance. Successful ESG compliance depends not only on standards and technology, but also on people. Building the right skills, awareness, and organizational culture is crucial to embed ESG practices effectively and sustainably. 20.2 Identifying training needs. Assess current staff knowledge and skills related to ESG, IFRS standards, and sustainability reporting. Identify gaps in understanding materiality, data collection, analysis, and disclosure requirements. Consider different roles: finance teams, sustainability professionals, auditors, IT staff, and senior management. 20.3 Designing effective training programs. Tailor content to specific audiences and their responsibilities. Include foundational ESG concepts and detailed IFRS S1 and S2 requirements. Use interactive formats such as workshops, e-learning modules, and case studies. Incorporate practical exercises on data management, reporting tools, and assurance processes. 20.4 Building cross-functional collaboration. Encourage joint training sessions involving finance, sustainability, risk, and legal teams. Foster shared understanding and alignment on ESG objectives and reporting processes. Promote open communication channels for ongoing learning and problem solving. 20.5 Leadership development. Provide targeted training for boards and executives on ESG risks, opportunities, and governance. Emphasize the strategic importance of ESG and the role of leadership in driving compliance. Equip leaders to engage with investors and stakeholders confidently on ESG matters. 20.6 Continuous learning and updates. Establish ongoing training to keep pace with evolving IFRS standards and regulatory changes. Encourage participation in external ESG forums, conferences, and professional networks. Leverage online resources, certifications, and expert consultations. 20.7 Measuring training effectiveness. Use assessments, feedback surveys, and performance metrics to evaluate training impact. Adjust programs based on evaluation results and emerging needs. Link training outcomes to improve ESG reporting quality and compliance. 20.8 Cultivating an ESG culture. Promote values of transparency, accountability, and sustainability throughout the organization. Recognize and reward contributions to ESG initiatives. Embed ESG responsibilities into job descriptions and performance evaluations. 20.9 Conclusion. Capacity building is a cornerstone of effective IFRS ESG compliance. Organizations investing in comprehensive ongoing training programs empower their people to deliver high-quality ESG disclosures, foster innovation, and drive sustainable success. Chapter 21: The Role of External Assurance in IFRS ESG Reporting. 21.1 Introduction: Why external assurance matters. As ESG disclosures become more critical for investors, regulators, and stakeholders, the reliability of reported information is paramount. External assurance provides independent verification that ESG disclosures are accurate, complete, and prepared in accordance with IFRS sustainability disclosure standards. 21.2 Objectives of external assurance. Enhance trust and credibility in ESG reports. Provide reasonable or limited assurance on ESG data and disclosures. Help identify data quality issues and control weaknesses. Support management in improving ESG reporting processes. 21.3 Types of assurance engagements. Limited assurance provides moderate confidence that ESG information is free of material misstatements. Typically involves inquiry and analytical procedures. Reasonable assurance provides higher confidence through more detailed testing and verification, similar to financial audits. Agreed upon procedures, specific procedures agreed with the client, focusing on particular ESG metrics or processes. Third-party certifications, verification by specialized bodies, e.g., carbon offset certifications. 21.4 Scope of assurance. Verification of quantitative ESG metrics, such as greenhouse gas emissions, water usage, and diversity statistics. Review of qualitative disclosures, including policies, governance frameworks, and risk descriptions. Assessment of processes, controls, and data management systems underpinning ESG reporting. 21.5 Assurance providers. Accounting and audit firms traditionally lead ESG assurance engagements leveraging financial audit expertise. Specialized ESG assurance providers, firms with expertise in sustainability, environmental science, and social impact. Hybrid approaches, collaboration between auditors and technical experts to cover complex ESG topics. 21.6 Assurance standards and frameworks. ISA E3000 revised, International Standard for Assurance Engagements other than audits or reviews of historical financial information. AA1000 Assurance Standard focuses on accountability and stakeholder engagement. Emerging standards tailored to ESG and IFRS sustainability disclosure standards are under development. 21.7 Challenges in ESG assurance. Lack of standardized ESG metrics and definitions. Variability in data quality and availability. Complexity of qualitative disclosures. Evolving assurance standards and expectations. Cost and resource considerations. 21.8 Best practices for successful assurance. Early engagement with assurance providers during ESG reporting cycle. Robust internal controls and documentation of ESG data. Clear communication of scope, objectives, and limitations of assurance. Continuous improvement based on assurance findings. Alignment of assurance scope with stakeholder needs and regulatory requirements. 21.9 The future of ESG assurance. Increasing demand for mandatory external assurance by regulators. Development of integrated assurance models, combining financial and ESG information. Use of technology such as AI and blockchain to enhance assurance processes. Growth of assurance services focusing on ESG impact and outcomes, not just data accuracy. 21.10 Conclusion. External assurance plays a vital role in bolstering the credibility and usefulness of ESG disclosures under IFRS standards. Organizations embracing assurance not only meet stakeholder expectations, but also strengthen their ESG governance and risk management frameworks. Chapter 22. Aligning IFRS ESG compliance with corporate ethics and culture. 22.1 Introduction. The foundation of sustainable compliance. Compliance with IFRS ESG standards goes beyond technical reporting requirements. It is deeply rooted in an organization's ethics and culture, the shared values, behaviors, and mindsets that shape how ESG principles are understood and acted upon across the business. 22.2 The role of corporate ethics in ESG compliance. Integrity and transparency. Ethical conduct ensures honesty in data collection, disclosure, and communication. Accountability. Embedding ethics encourages ownership of ESG responsibilities at all levels. Fairness and respect. Ethical values promote social and governance disclosures that reflect real impacts, not just window dressing. Long-term orientation. ethics drive decisions that balance short-term pressures with sustainable value creation. 22.3 Building a culture that supports ESG. Leadership commitment to model ethical behavior and sustainability priorities. Clear communication of ESG values and expectations to all employees. Incentivizing ethical and sustainable practices through rewards, recognition, and career development. Encouraging open dialogue and whistleblowing mechanisms related to ESG issues. 22.4 Embedding ESG into organizational practices. Integrate ESG criteria into performance evaluations and promotion decisions. Incorporate sustainability principles in procurement, operations, and innovation processes. Foster cross-departmental collaboration to break silos and enhance ESG integration. Ensure diversity and inclusion to enrich culture and perspectives. 22.5 Ethical considerations in ESG data and reporting. Avoid greenwashing and misrepresentation by upholding accuracy and completeness. Address conflicts of interest transparently. Respect privacy and confidentiality in ESG data handling. Commit to continuous improvement and responsiveness to stakeholder concerns. 22.6 Case study. Ethical culture driving ESG excellence. A multinational corporation enhanced its ESG compliance by embedding ESG ethics into its code of conduct, training employees on ethical decision-making and sustainability, establishing an ethics committee overseeing ESG practices, linking executive compensation to ethical and ESG performance. Result: the company achieved robust ESG disclosures and was recognized for ethical leadership and stakeholder trust. 22.7 Measuring and sustaining ethical ESG culture. Use employee surveys and ESG audits to assess culture alignment. Track ethics-related incidents and ESG compliance breaches. Adjust policies and training to address gaps. Celebrate successes and integrate lessons learned. 22.8 Conclusion. Aligning IFRS ESG compliance with a strong ethical foundation and supportive corporate culture transforms reporting from a compliance exercise into a genuine commitment to sustainability and stakeholder trust. This alignment is essential for authentic, impactful ESG performance and disclosures. Chapter 23: ESG compliance in different industry sectors. 23.1 Introduction: the need for sector-specific ESG approaches. While IFRS sustainability disclosure standards provide a global framework, ESG issues and materiality vary significantly by industry. Tailoring compliance strategies to sector-specific risks, impacts, and stakeholder expectations is critical for meaningful ESG reporting. 23.2 Energy and utilities. Key ESG issues: climate change impact, carbon emissions, renewable energy transition, resource depletion, community relations, regulatory compliance. Reporting focus: greenhouse gas disclosures, climate risk scenarios, environmental impact, safety and governance practices. Challenges: managing transition risks, balancing fossil fuels with renewables, stakeholder scrutiny. Best practices: robust climate risk modeling, transparent carbon reporting, community engagement programs. 23.3 Financial services. Key ESG issues: responsible lending and investment, social inclusion, governance, cybersecurity, data privacy. Reporting focus: ESG integration in credit risk, portfolio emissions, diversity and inclusion, anti-corruption measures. Challenges: measuring financed emissions, avoiding greenwashing, data complexity. Best practices: incorporating ESG into credit and investment decision-making, robust governance frameworks, transparent disclosures. 23.4 Manufacturing. Key ESG issues: resource efficiency, waste management, labor practices, health and safety, supply chain management. Reporting focus: environmental footprint, social impact on workers, governance policies. Challenges: complex supply chains, ensuring data accuracy, worker safety. Best practices, supplier audits, worker welfare programs, energy efficiency initiatives. 23.5 Technology and telecommunications. Key ESG issues, data privacy, digital inclusion, energy consumption, innovation ethics. Reporting focus, cybersecurity, diversity in tech workforce, energy use in data centers. Challenges, rapid technology changes, balancing innovation and ethics. Best practices, strong data protection policies, inclusive hiring practices, energy efficient infrastructure. 23.6 Consumer goods and retail. Key ESG issues, sustainable sourcing, packaging waste, labor rights, product safety. Reporting focus, supply chain transparency, fair labor practices, waste reduction efforts. Challenges, complex global supply chains, consumer expectations, regulatory compliance. Best practices, traceability systems, sustainable product development, stakeholder engagement. 23.7 Healthcare and pharmaceuticals. Key ESG issues, access to medicines, ethical clinical trials, environmental impact of manufacturing. Reporting focus, patient safety, drug pricing ethics, environmental compliance. Challenges, balancing profitability with social responsibility, complex regulations. Best practices, transparent clinical data reporting, patient access programs, green manufacturing processes. 23.8 Real estate and construction. Key ESG issues, energy efficient buildings, sustainable materials, community impact, health and safety. Reporting focus, building certifications, environmental impact, worker safety. Challenges, managing diverse stakeholder interests, integrating ESG early in project design. Best practices, green building standards, community consultation, safety programs. 23.9 Public sector and nonprofits. Key ESG issues, public accountability, social equity, environmental stewardship. Reporting focus, impact measurement, transparency, governance. Challenges, resource constraints, diverse stakeholder needs. Best practices, clear impact metrics, participatory governance, transparent reporting. 23.10 Conclusion. ESG compliance under IFRS standards must reflect the unique risks, impacts, and opportunities of each industry. Organizations that customize their ESG approaches while adhering to global standards enhance relevance, credibility, and stakeholder value. Chapter 24, IFRS ESG Compliance for SMEs. 24.1 Introduction, Why ESG Matters for SMEs. Small and medium-sized enterprises, SMEs, play a vital role in the global economy and supply chains. Although ESG compliance and reporting have traditionally focused on large corporations, SMEs increasingly face stakeholder demands for sustainability, transparency, and responsible practices. 24.2 Unique challenges for SMEs. Limited resources. SMEs often lack dedicated sustainability teams, budgets, and advanced technology. Complexity of standards. IFRS ESG standards may seem complex and resource-intensive. Data collection difficulties. Limited systems for tracking environmental and social metrics. Regulatory pressure. Varying regional requirements and supply chain demands. Capacity constraints. Limited expertise in ESG topics and reporting. 24.3 Benefits of ESG compliance for SMEs. Access to markets. Many large buyers require ESG compliance from suppliers. Investment opportunities. Growing investor interest in sustainable SMEs. Operational efficiency, resource saving and risk reduction. Reputation and trust. Building stronger relationships with customers and communities. Future-proofing. Preparing for evolving regulations and market expectations. 24.4 Simplifying IFRS ESG standards for SMEs. Focus on material ESG topics relevant to the SME's industry and operations. Use scaled reporting frameworks tailored to SME capacities. Leverage sector-specific guidance and simplified templates. Adopt a phased approach, starting with foundational disclosures and expanding over time. 24.5 Practical Steps for SMEs. Conduct a materiality assessment. Identify key ESG issues impacting business and stakeholders. Develop a basic ESG policy. Set clear, achievable sustainability commitments. Implement simple data collection. Use spreadsheets or basic software to track key metrics. Engage stakeholders. Communicate openly with customers, suppliers, and employees. Use external resources. Tap into local business associations, government programs, and ESG consultants. Integrate ESG into business strategy. Align sustainability goals with core operations and growth plans. 24.6 Leveraging technology. Affordable tools for ESG data management and reporting. Cloud-based platforms for scalability. Mobile apps for on-the-ground data collection. 24.7 Capacity building. Train key staff on ESG basics and IFRS standards. Encourage knowledge sharing within networks or industry groups. Participate in ESG certification or recognition programs. 24.8 Case study. A manufacturing SME embedding ESG. An SME in manufacturing identified energy use and waste management as material topics. Set targets to reduce electricity consumption by 15% in 2 years. Engage suppliers on responsible sourcing. Produced a simplified ESG report aligned with IFRS S1 disclosure principles. Outcome: improved operational efficiency, stronger customer relationships, and readiness for future ESG requirements. 24.9 Conclusion. While SMEs face distinct challenges, adopting IFRS ESG compliance is achievable and beneficial with a pragmatic, scalable approach. Early ESG integration strengthens SME's resilience, competitiveness, and contributions to sustainable development. Chapter 25: Regulatory Landscape and IFRS ESG Compliance. 25.1 Introduction: The Rising Tide of ESG Regulation. Governments, regulators, and stock exchanges worldwide are increasingly mandating ESG disclosures to promote transparency, investor protection, and sustainable economic growth. Understanding the regulatory landscape is essential for effective IFRS ESG compliance. 25.2 Global Regulatory Developments. European Union (EU). The Corporate Sustainability Reporting Directive, CSRD, requires detailed ESG disclosures for large companies and listed SMEs. The EU Taxonomy Regulation establishes classification criteria for sustainable activities. The Sustainable Finance Disclosure Regulation, SFDR, targets financial market participants. United States. The Securities and Exchange Commission, SEC, is advancing rulemaking on climate-related disclosures. State-level initiatives complement federal efforts. Voluntary frameworks like SASB and TCFD have broad adoption. Asia-Pacific. Increasing ESG mandates in Japan, Singapore, South Korea, and China. Development of regional sustainability reporting guidelines. Focus on climate risk, social issues, and governance improvements. 25.3 IFRS Sustainability Disclosure Standards in Context. The IFRS Foundation's International Sustainability Standards Board, ISSB, aims to harmonize global ESG reporting. IFRS S1 and S2 standards emphasize enterprise value relevance, connectivity with financial reporting, and investor needs. Alignment with other frameworks, e.g., TCFD, SASB, to reduce fragmentation. 25.4 National and Regional Adoption Challenges. Variations in regulatory scope, timing, and enforcement. Differences in sectoral focus and materiality definitions. Balancing global consistency with local relevance. Capacity and resource challenges for companies. 25.5 Impact on corporations. Need for multi-framework compliance strategies. Increased scrutiny from investors, regulators, and civil society. Greater demand for ESG governance, controls, and assurance. Potential penalties and reputational risks for non-compliance. 25.6 Role of regulators in driving ESG quality. Issuing guidance and clarifications on standards. Promoting external assurance and audit integration. Facilitating stakeholder engagement and transparency. Encouraging innovation in ESG data and technology. 25.7 Future outlook. Continued convergence of ESG standards globally. Expansion of mandatory ESG disclosure requirements. Enhanced regulatory focus on social and governance factors. Increased integration of ESG in corporate governance codes. 25.8 Best practices for navigating regulation. Stay informed on evolving ESG regulatory developments. Build agile reporting systems, adaptable to changing requirements. Engage with regulators and industry groups proactively. Develop comprehensive ESG governance and risk management frameworks. 25.9 Conclusion. Navigating the dynamic regulatory landscape is critical for successful IFRS ESG compliance. Organizations that anticipate and adapt to regulatory trends position themselves as leaders in transparency, sustainability, and stakeholder trust. Chapter 26. The Future of IFRS and ESG Compliance. 26.1 Introduction. A dynamic and transformative journey. The integration of ESG factors into financial reporting is still a rapidly evolving field. IFRS sustainability disclosure standards represent a significant milestone, but the future promises ongoing transformation driven by market demands, regulatory developments, and technological advancements. 26.2 Increasing standardization and global convergence. Efforts to unify disparate ESG frameworks continue to gain momentum. The ISSB and other standard setters aim to streamline reporting to reduce complexity. Expect tighter alignment with financial accounting standards to enhance comparability and decision usefulness. 26.3 Expanding scope and depth of ESG reporting. Broader coverage of environmental, social, and governance issues, including biodiversity, human rights, and supply chain impacts. Enhanced focus on forward-looking disclosures, scenario analysis, and impact measurement. Integration of financial and non-financial data for holistic enterprise value assessments. 26.4 Role of technology and data innovation. Artificial intelligence and big data analytics will play a growing role in ESG data gathering, verification, and reporting. Blockchain and distributed ledger technologies may enable transparent and immutable ESG disclosures. Automation and digital platforms will facilitate real-time sustainability reporting. 26.5 Enhanced assurance and accountability. External assurance of ESG disclosures is expected to become mandatory in many jurisdictions. Development of assurance standards tailored to evolving ESG risks and data types. Increased stakeholder demand for verified and trustworthy ESG information. 26.6 Integration with corporate strategy and risk management. ESG compliance will become integral to enterprise risk management frameworks. Boards and leadership will embed sustainability considerations into strategy, capital allocation, and incentives. Organizations will move from compliance to value creation through ESG. 26.7 Addressing social and governance challenges. Growing emphasis on social equity, diversity, inclusion, and human rights. Stronger governance requirements around ethics, anti-corruption, and executive accountability. Heightened stakeholder activism, driving corporate transparency and responsibility. 26.8 Challenges ahead. Managing data complexity and quality at scale. Balancing transparency with confidentiality. keeping pace with rapid regulatory changes. Ensuring inclusivity across geographies and industries. 26.9 Preparing for the future. Foster a culture of continuous learning and agility. Invest in technology and human capital for ESG expertise. Engage proactively with standard setters, regulators, and stakeholders. Embed sustainability into core business models and innovation. 26.10 Conclusion. The future of IFRS and ESG compliance is one of continuous evolution toward greater integration, transparency, and impact. Organizations that anticipate change, embrace innovation, and align ESG with their purpose will thrive in the new era of sustainable finance. Chapter 27 Case Studies in IFRS ESG Compliance. 27.1 Introduction Learning from Experience. Examining practical case studies provides valuable insights into challenges, solutions, and best practices in IFRS ESG compliance. This chapter highlights diverse sectors and organizational sizes to illustrate the range of approaches. 27.2 Case Study 1 Global Energy Company Climate Risk Integration. Background: a multinational energy corporation faced increasing investor demands for transparent climate-related disclosures aligned with IFRS S2 standards. Approach: conducted comprehensive climate risk assessments, including scenario analysis consistent with IPCC pathways. Integrated climate-related financial disclosures into annual reporting cycles. Engaged external assurance providers to verify emissions data. Outcome: improved investor confidence, stronger stakeholder relationships, and enhanced strategic planning for the energy transition. 27.3 Case Study 2 Financial Institution ESG in Lending Practices. Background: a regional bank sought to embed ESG considerations into its credit risk frameworks and comply with IFRS S1 disclosures. Approach: developed ESG risk scoring models for loan portfolios. Trained credit officers on sustainability risks and materiality assessments. Disclosed portfolio-level ESG metrics in sustainability reports. Outcome: better risk management, alignment with regulatory expectations, and access to green finance markets. 27.4 Case Study 3 Manufacturing SME Starting ESG Reporting Journey. Background: a mid-sized manufacturer with limited ESG experience aimed to meet supplier requirements and begin IFRS ESG compliance. Approach: conducted a materiality assessment focusing on energy use and labor practices. Implemented basic data collection systems and drafted a simplified ESG report. Engaged employees in sustainability training. Outcome: operational cost savings, enhanced supplier relationships, and groundwork for expanded ESG reporting. 27.5 Case Study 4 Technology Firm Data Privacy and Governance. Background: a global technology company faced intense scrutiny over data privacy and governance disclosures. Approach: mapped privacy risks and governance structures against IFRS S1 principles. Enhanced transparency in disclosures regarding cybersecurity policies and incident responses. Adopted third-party assurance to validate governance disclosures. Outcome: increased stakeholder trust, compliance with evolving regulations, and reputational protection. 27.6 Case Study 5 Consumer Goods Company Sustainable Supply Chain. Background: a multinational retailer sought to improve supply chain transparency and ESG performance. Approach: introduce supplier ESG assessments and audits aligned with IFRS S1 social disclosures. Reported on supplier diversity, labor conditions, and environmental impacts. Collaborated with NGOs for stakeholder engagement. Outcome: improved supply chain resilience, positive brand recognition, and reduced ESG risks. 27.7 Lessons learned. Early stakeholder engagement is critical. Tailoring ESG strategies to organizational context ensures relevance. Continuous improvement and transparency build trust. Investment in capacity and technology pays dividends. 27.8 Conclusion. These case studies demonstrate that while challenges vary, successful IFRS ESG compliance requires commitment, strategic integration, and stakeholder focus. Organizations can draw inspiration and practical guidance from these examples to advance their sustainability journeys. Chapter 28: ESG Data Management Systems. 28.1 Introduction: The Foundation of Reliable ESG Reporting. Accurate and transparent ESG reporting under IFRS standards depends heavily on robust data management systems. These systems collect, process, verify, and report ESG information that meets the expectations of regulators, investors, and other stakeholders. 28.2 Key Requirements for ESG Data Management. Data accuracy and completeness, capturing reliable data covering all relevant ESG metrics. Traceability and auditability, maintaining clear records and audit trails for ESG information. Consistency and comparability, standardizing data collection to allow meaningful comparisons over time and across entities. Timeliness, providing up-to-date information to meet reporting deadlines. Security and confidentiality, protecting sensitive ESG data from unauthorized access or breaches. 28.3 Components of an effective ESG data management system. Data collection tools, automated sensors, IoT devices, surveys, and manual inputs. Data integration platforms, systems that consolidate data from diverse sources, including operations, finance, supply chains, and external providers. Data validation and quality controls, procedures and software to check for errors, anomalies, and completeness. Data analytics and reporting software, tools that generate insights, dashboards, and standardized IFRS-compliant disclosures. Governance and controls, policies defining roles, responsibilities, and data handling standards. 28.4 Technologies supporting ESG data management. Cloud computing enables scalable storage and real-time data access. Artificial intelligence and machine learning enhance data processing, anomaly detection, and predictive analytics. Blockchain offers transparent, immutable ledgers for ESG data integrity. Enterprise resource planning (ERP) integration links ESG data with financial and operational systems. Mobile applications facilitate field data collection and engagement. 28.5 Challenges in ESG data management. Data fragmentation across departments and geographies. Inconsistent definitions and metrics. Difficulties capturing qualitative and forward-looking information. Integrating ESG data with traditional financial reporting. Ensuring data privacy and regulatory compliance. 28.6 Best Practices. Establish a clear ESG data strategy aligned with IFRS requirements. Standardize ESG metrics and reporting formats. Invest in staff training and cross-functional collaboration. Regularly audit and update data management systems. Leverage external expertise and technology partners. 28.7 Case Study: Implementing an ESG data system in a multinational. A global manufacturing firm implemented a centralized ESG data platform that automated energy and emissions data capture, integrated supplier ESG assessments, provided dashboards for management and IFRS S1, S2 aligned reporting, resulted in improved data quality, reporting efficiency, and stakeholder confidence. 28.8 Conclusion. Effective ESG data management systems are essential enablers of trustworthy IFRS ESG compliance. By embracing technology, governance, and continuous improvement, organizations can meet disclosure demands and drive sustainable business value. Chapter 29: Assurance and Verification of ESG Reports. 29.1 Introduction: The need for assurance in ESG reporting. As ESG disclosures become more critical for investors and regulators, the demand for assurance, independent verification of the reported information, is increasing. Assurance enhances the reliability, credibility, and comparability of ESG reports aligned with IFRS standards. 29.2 Types of ESG assurance. Limited assurance provides moderate confidence that the ESG information is free from material misstatements, typically involves review procedures. Reasonable assurance offers a higher level of confidence based on more extensive testing and verification. Internal assurance, conducted by an organization's internal audit or sustainability teams. External assurance, provided by independent third-party auditors or specialized assurance providers. 29.3 Assurance Standards and Frameworks. International Auditing and Assurance Standards Board, IAASB standards, including ISAE 3000 for assurance engagements. Accountability A1000 Assurance Standard focuses on the principles of inclusivity, materiality, and responsiveness. SASB Assurance Guidelines, linked to sustainability accounting standards. Other regional and national assurance frameworks and guidelines. 29.4 Scope of assurance engagements. Verification of quantitative data, such as emissions, energy use, or diversity statistics. Review of qualitative disclosures, including policies, governance, and risk management. Assessment of the data collection processes and controls. Evaluation of alignment with IFRS Sustainability Disclosure Standards, S1, S2. 29.5 Benefits of ESG assurance. Increase stakeholder trust and investor confidence. Improve data quality and reporting processes. Identification of gaps and opportunities for improvement. Enhanced compliance with regulatory and voluntary frameworks. 29.6 Challenges in ESG assurance. Diverse and evolving ESG metrics and methodologies. Availability of skilled assurance providers. Balancing cost with the desired level of assurance. Ensuring independence and managing conflicts of interest. Integrating ESG assurance with financial audits. 29.7 Best practices for effective ESG assurance. Define clear assurance objectives and scope. Engage qualified and experienced assurance providers. Maintain transparent communication with stakeholders. Incorporate assurance findings into continuous improvement efforts. Ensure alignment with IFRS reporting timelines and requirements. 29.8 Emerging trends in ESG assurance. Increasing use of technology such as AI and blockchain to support verification. Growing emphasis on integrated assurance combining financial and ESG audits. Development of sector-specific assurance guidelines. Expansion of mandatory assurance requirements in certain jurisdictions. 29.9 Conclusion. Assurance and verification are vital to the credibility of ESG reports and IFRS compliance. Organizations that invest in robust assurance practices enhance transparency, reduce risks, and strengthen stakeholder relationships. Chapter 30: Integrating ESG into Corporate Governance. 30.1 Introduction: The Governance Imperative for ESG. Corporate governance serves as the backbone for effective ESG integration. Sound governance structures ensure that ESG risks and opportunities are overseen at the highest levels, aligning sustainability with business strategy and IFRS ESG disclosure requirements. 30.2 The Role of the Board of Directors. Strategic oversight. Boards must understand and guide ESG strategy to align with corporate goals and stakeholder expectations. Risk management. ESG risks, climate, social, regulatory, should be embedded in enterprise risk frameworks. Disclosure responsibility. Boards oversee the accuracy, completeness, and timeliness of ESG disclosures in line with IFRS standards. Stakeholder engagement, ensuring transparent communication with investors, employees, regulators, and communities. 30.3 Governance structures supporting ESG. ESG committees, specialized committees dedicated to sustainability oversight. Cross-functional teams, collaboration among finance, risk, compliance, and sustainability units. Chief Sustainability Officer, CSO, or equivalent roles, leadership focused on driving ESG initiatives and reporting. Integration with audit committees, inclusion of ESG considerations in audit scopes and assurance processes. 30.4 Board competencies and training. ESG literacy and awareness of IFRS sustainability standards. Understanding of emerging ESG risks and regulatory landscapes. Skills in evaluating ESG data and disclosures. Continuous education on best practices and innovations. 30.5 Embedding ESG in corporate policies. Code of conduct reflecting ESG commitments. Policies on environmental stewardship, social responsibility, and ethical governance. Incentive structures linking executive remuneration to ESG performance. Transparent whistleblower mechanisms and ethical reporting channels. 30.6 ESG risk management and internal controls. Identification and assessment of ESG-related risks. Integration of ESG metrics into internal control frameworks. Monitoring compliance with ESG policies and regulatory requirements. Reporting to the board on ESG performance and issues. 30.7 Enhancing ESG disclosure governance. Assigning clear roles for ESG data ownership and reporting. Establishing processes for data verification and assurance. Aligning disclosure practices with IFRS S1 and S2 standards. Ensuring timely updates and stakeholder responsiveness. 30.8 Benefits of strong ESG governance. Improved risk management and resilience. Enhanced reputation and stakeholder trust. Better decision-making and long-term value creation. Greater readiness for regulatory compliance and capital market demands. 30.9 Challenges and solutions. Overcoming resistance to change at leadership levels. Balancing short-term pressures with long-term ESG goals. Integrating ESG with existing governance frameworks without duplication. Using external advisors and training to build capacity. 30.10 Conclusion. Effective integration of ESG into corporate governance is essential to meet IFRS ESG compliance and realize sustainability goals. Strong governance drives accountability, transparency, and strategic alignment, ensuring organizations thrive in the evolving ESG landscape. Chapter 31 Industry-specific IFRS ESG compliance guidance. 31.1 Introduction. The need for industry tailoring. While IFRS sustainability disclosure standards, S1 and S2, provide a comprehensive framework, the material ESG topics and compliance approaches vary widely by industry. This chapter explores sector-specific ESG issues and practical guidance to help organizations align IFRS ESG disclosures with their operational realities. 31.2 Energy and utilities. Key ESG topics: climate change and greenhouse gas emissions, transition risks, renewable energy adoption, environmental impact, community relations, and regulatory compliance. IFRS S2 focus: detailed climate-related financial disclosures, including scenario analysis and resilience planning. Best practices: robust carbon accounting and emissions reduction targets. Transparent reporting on fossil fuel dependency and transition strategies. Stakeholder engagement on environmental and social impacts. 31.3 Financial services. Key ESG topics: responsible lending and investment, social impact financing, governance and ethics, climate risk and portfolios. IFRS S1 focus: disclosure of sustainability risks affecting financial performance, governance oversight. Best practices. Integration of ESG risk assessment in credit and investment decisions. Reporting on sustainable finance products and impact metrics. Enhanced disclosure of governance and anti-corruption measures. 31.4 Manufacturing. Key ESG topics: energy efficiency, waste and pollution management, labor practices, supply chain sustainability, product lifecycle impacts. IFRS focus: both environmental and social disclosures material to operational and financial performance. Best practices. Implementation of circular economy principles. Supplier ESG performance monitoring and engagement. Reporting on occupational health and safety metrics. 31.5 Technology and telecommunications. Key ESG topics: data privacy and security, innovation for sustainability, electronic waste management, labor diversity and inclusion. IFRS focus: governance disclosures and social factors related to data ethics and workforce. Best practices. Transparent reporting on cybersecurity and data governance. Initiatives supporting diversity and inclusion. Environmental management of supply chains and product end of life. 31.6 Consumer goods and retail. Key ESG topics: sustainable sourcing, packaging and waste reduction, product safety, labor rights, community impact. IFRS focus: emphasis on supply chain transparency and social disclosures. Best practices. Traceability of raw materials and responsible sourcing policies. Initiatives to reduce packaging waste and carbon footprint. Consumer engagement on sustainability issues. 31.7 Healthcare and pharmaceuticals. Key ESG topics: access to medicines, ethical clinical trials, product safety, environmental impacts of manufacturing. IFRS focus: governance and social disclosures emphasizing ethics and patient safety. Best practices. Transparency on pricing and access programs. Robust ethical standards in research and development. Environmental risk management of chemical waste. 31.8 Real estate and construction. Key ESG topics: energy efficient buildings, sustainable materials, community impact, labor safety. IFRS focus: environmental disclosures related to asset performance and risk. Best practices. Adoption of green building certifications. Reporting on construction site safety and labor standards. Community consultation and impact assessments. 31.9 Transportation and logistics. Key ESG topics: emissions reduction, fuel efficiency, labor conditions, supply chain resilience. IFRS focus: environmental and social factors affecting operational risks and costs. Best practices. Investment in low-emission technologies. Transparent reporting on driver and labor welfare. Supply chain risk management. 31.10 Conclusion. Understanding and addressing industry-specific ESG issues is crucial for meaningful IFRS ESG compliance. Organizations that tailor their disclosures to sector realities can better manage risks, capture opportunities, and communicate value to stakeholders. Chapter 32: Practical Tools and Resources for IFRS ESG Compliance. 32.1 Introduction: Equipping Organizations for Success. Achieving compliance with IFRS sustainability disclosure standards requires more than knowledge. It demands practical tools, technologies, and resources. This chapter highlights key aids that can streamline ESG data collection, analysis, reporting, and governance. 32.2 Frameworks and Standards. IFRS Sustainability Disclosure Standards, S1 and S2, the primary reference for ESG reporting principles and climate-related disclosures. Global Reporting Initiative, GRI, provides detailed ESG performance indicators, complementing IFRS disclosures. Sustainability Accounting Standards Board, SASB, industry-specific metrics aiding materiality assessment. Task Force on Climate-Related Financial Disclosures, TCFD, guidance for climate risk reporting aligned with IFRS S2. CDP, Carbon Disclosure Project, framework for environmental data disclosure and benchmarking. 32.3 ESG data management and reporting software. Integrated reporting platforms. Tools like Workiva, OneTrust, and SAP Sustainability Performance Management facilitate data integration, validation, and reporting. Environmental Management Systems, EMS, software for tracking energy emissions and waste, e.g. Enablon Sphera. Supply Chain ESG tools, platforms that assess and monitor supplier sustainability performance. Data analytics and visualization. Tools such as Power BI or Tableau to create dashboards and interpret ESG data. 32.4 Assurance and verification resources. Audit firms, large accounting and consulting firms offering ESG assurance services tailored to IFRS requirements. Assurance standards, ISA E3000, AA1000AS, and other guidelines that shape the assurance process. Third-party verifiers, specialized sustainability assurance providers. 32.5 Training and capacity building. Professional courses. IFRS Foundation offers training on sustainability disclosure standards. Industry associations. Organizations such as the Chartered Institute of Management Accountants, CIMA, provide ESG education. Workshops and webinars. Regular updates on emerging trends and practical compliance tips. 32.6 Regulatory and guidance documents. Jurisdictional guidelines. Regional regulators may issue ESG disclosure mandates and interpretive guidance. IFRS Foundation publications, technical papers, illustrative examples, and application guidance. Best practice guides, published by sustainability consultancies and standard setters. 32.7 Stakeholder engagement tools. Surveys and feedback platforms, tools like SurveyMonkey or specialized stakeholder engagement software. Communication channels, social media management tools to disseminate ESG reports and updates. Materiality assessment tools, facilitate identifying and prioritizing ESG topics through stakeholder input. 32.8 Developing an ESG compliance roadmap. Use project management software, e.g., Asana, Trello, to coordinate ESG initiatives. Develop milestones aligned with IFRS reporting timelines. Assign responsibilities and track progress using governance dashboards. 32.9 Conclusion. By leveraging the right tools and resources, organizations can navigate the complexities of IFRS ESG compliance more efficiently and effectively. Investment in these aids supports better data quality, transparency, and ultimately stronger sustainability performance. Chapter 33 Communicating ESG Performance to Stakeholders. 33.1 Introduction. The importance of transparent ESG communication. Clear and credible communication of ESG performance is vital to build trust with investors, regulators, customers, employees, and the wider public. It reinforces accountability and demonstrates how organizations meet IFRS sustainability disclosure standards. 33.2 Identifying key stakeholders. Investors and analysts require detailed standardized ESG data to assess risks and opportunities. Regulators expect compliance with mandatory disclosure requirements. Employees seek engagement on sustainability commitments and workplace impacts. Customers and consumers increasingly demand responsible products and corporate ethics. Communities and NGOs interested in environmental and social impacts. Media and public influence reputation through coverage and perceptions. 33.3 Channels for ESG communication. Annual and sustainability reports. Formal comprehensive disclosures aligned with IFRS S1 and S2. Investor presentations and calls, interactive forums for discussing ESG strategies and performance. Corporate websites and ESG portals, accessible platforms for up-to-date ESG information. Social media, real-time engagement and awareness building. Press releases and media outreach highlight achievements and respond to issues. Employee newsletters and workshops foster internal understanding and participation. 33.4 Content and messaging. Material ESG topics focus on issues most relevant to business and stakeholders. Performance metrics, quantitative data supported by narrative context. Governance and risk management, transparency on oversight and controls. Forward-looking statements, disclose targets, strategies, and climate scenario planning. Challenges and progress, honest discussion of hurdles and improvement efforts. Third-party assurance, highlight independent verification to boost credibility. 33.5 Aligning with IFRS disclosure requirements. Use IFRS S1 principles for general sustainability disclosures, emphasizing relevance, faithful representation, and comparability. Follow IFRS S2 guidance for climate-related financial disclosures, including risk assessments and resilience analysis. Ensure disclosures are integrated with financial reporting for a holistic view. 33.6 Best practices for effective communication. Tailor messages to stakeholder interests and technical understanding. Use clear, jargon-free language supported by visuals and data graphics. Maintain regular and consistent disclosure cycles. Engage stakeholders proactively to gather feedback and build dialogue. Leverage storytelling to connect ESG performance to corporate purpose. 33.7 Measuring impact of ESG communication. Monitor stakeholder engagement metrics, e.g., report downloads, website traffic. Conduct surveys to assess perception and trust. Track changes in investor behavior, such as capital flows or shareholder resolutions. Analyze media coverage and social sentiment. 33.8 Challenges and solutions. Balancing transparency with confidentiality. Avoiding greenwashing through substantiated claims. Keeping pace with evolving standards and stakeholder expectations. Using digital tools and professional support to enhance communication quality. 33.9 Conclusion. Effective ESG communication is a cornerstone of successful IFRS ESG compliance. Organizations that communicate transparently and authentically build stronger relationships, mitigate risks, and enhance long-term value. Chapter 34. The Future of IFRS ESG Reporting. 34.1 Introduction. The ESG reporting landscape is evolving. As ESG considerations gain prominence, IFRS sustainability disclosure standards are expected to evolve alongside advances in technology, regulatory shifts, and growing stakeholder demands. This chapter highlights key developments shaping the future of ESG reporting. 34.2 Increasing regulatory convergence and global standards. Harmonization of ESG frameworks. Efforts by the IFRS Foundation, SEC, EU, and others to align ESG disclosure requirements, reducing fragmentation and enhancing comparability. Mandatory ESG reporting. Expansion of obligatory disclosures across jurisdictions, raising the bar for compliance. Integration with financial reporting. Greater blending of ESG and financial information into a cohesive reporting package. 34.3 Advances in technology and data analytics. Automation and real-time reporting. Use of AI, IoT, and blockchain for continuous ESG data collection, verification, and disclosure. Enhanced data quality. Predictive analytics and machine learning, improving accuracy and materiality assessments. Digital reporting platforms. Interactive, user-friendly ESG reports that enable dynamic stakeholder engagement. 34.4 Focus on impact and outcomes. Shift from input and process metrics toward outcome-based disclosures that demonstrate actual environmental and social impacts. Greater emphasis on value creation and long-term sustainability performance. Integration of impact measurement frameworks aligned with the UN Sustainable Development Goals, SDGs. 34.5 Expansion of assurance and audit practices. Development of standards for integrated assurance, covering both financial and ESG data. Increased demand for independent verification to combat greenwashing and enhance credibility. Use of technology to streamline assurance processes. 34.6 Broader scope of ESG topics. Inclusion of emerging issues such as biodiversity, human rights, data ethics, and supply chain transparency. Greater scrutiny on social equity and governance diversity. Development of sector-specific guidance addressing nuanced risks and opportunities. 34.7 Stakeholder engagement and transparency. More participatory approaches involving stakeholders in defining material topics. Transparent disclosures of methodologies, assumptions, and uncertainties. Enhanced communication tools, fostering dialogue and accountability. 34.8 Challenges ahead. Balancing detailed disclosures with information overload. Addressing data privacy and cybersecurity concerns. Ensuring equitable access to ESG reporting capabilities across regions and company sizes. Managing the pace of regulatory and technological change. 34.9 Preparing for the future. Recommendations for organizations. Invest in ESG literacy and data infrastructure. Monitor regulatory developments and participate in standard-setting consultations. Foster cross-functional collaboration between finance, sustainability, and risk teams. Embrace innovation in reporting and assurance methods. Maintain flexibility to adapt ESG disclosures as standards evolve. 34.10 Conclusion. The future of IFRS ESG reporting promises greater transparency, integration, and impact. Organizations proactive in adapting to these changes will be better positioned to meet stakeholder expectations, drive sustainable growth, and navigate the complexities of the evolving ESG landscape. Chapter 35 Case Studies in IFRS ESG Compliance. 35.1 Introduction Learning from Practice. Examining practical applications of IFRS ESG compliance reveals insights into effective strategies, common pitfalls, and innovative solutions. This chapter showcases case studies from various industries, demonstrating the journey toward robust ESG reporting. 35.2 Case Study 1 Energy Sector Transitioning to Low Carbon. Company, Global Energy Corp. Context. Facing stringent climate regulations and investor demands, the company undertook a comprehensive ESG reporting overhaul to align with IFRS S1 and S2. Key actions. Conducted scenario analysis to assess resilience under different climate pathways. Integrated climate risks into enterprise risk management. Enhanced greenhouse gas (GHG) data collection and external assurance. Developed transparent disclosures on transition plans and targets. Outcomes. Improved investor confidence and credit ratings. Identification of cost-saving energy efficiency measures. Stronger regulatory compliance and market positioning. 35.3 Case Study 2 Financial Services Embedding ESG in Investment Decisions. Company, Future Finance Limited. Context. The firm integrated ESG factors into portfolio management and aligned disclosures with IFRS standards to meet growing client expectations. Key actions. Adopted SASB and TCFD frameworks alongside IFRS disclosures. Trained analysts on ESG risk assessment and reporting. Published detailed reports on sustainable investment products. Engaged third-party assurance providers to verify disclosures. Outcomes. Attraction of new ESG-focused investors. Enhanced risk management and portfolio resilience. Increased transparency fostering stakeholder trust. 35.4 Case Study 3 Manufacturing, Supply Chain Sustainability. Company, Global Manufacturing Inc. Context. Facing scrutiny on labor practices and environmental impact, the company expanded ESG disclosures under IFRS to cover supply chain risks. Key actions: implemented supplier ESG audits and risk scoring, integrated supply chain data into sustainability reports, engaged stakeholders through materiality assessments, developed improvement programs with key suppliers. Outcomes: reduction in supply chain risks and violations, strengthened supplier relationships, enhanced brand reputation and customer loyalty. 35.5 Case Study 4: Technology, Data Privacy and ESG Governance. Company: Tech Innovate Limited. Context: with increasing focus on data ethics and governance, the company aligned its ESG reporting with IFRS principles, emphasizing governance and social factors. Key actions: established cross-functional ESG governance committees, reported on data privacy incidents and mitigation efforts, disclosed workforce diversity and inclusion metrics, ensured board oversight of ESG risks. Outcomes: improved internal ESG culture and accountability, positive stakeholder feedback on transparency, enhanced compliance with evolving regulations. 35.6 Lessons learned across case studies. Early engagement with IFRS standards and regulatory expectations is crucial. Cross-departmental collaboration enhances ESG data quality and reporting. Assurance and transparency build stakeholder confidence. Tailored approaches aligned with industry-specific risks deliver better outcomes. Continuous improvement and innovation drive sustained ESG performance. 35.7 Conclusion. These case studies illustrate how organizations across sectors are navigating the complexities of IFRS ESG compliance. Their experiences provide valuable guidance and inspiration for others striving to meet sustainability reporting challenges and opportunities. Chapter 36: Summary and Final Thoughts. 36.1 Recap of key themes. Throughout this book, we have explored the intricate relationship between IFRS sustainability disclosure standards and environmental, social, and governance (ESG) compliance. Key themes include the importance of ESG compliance, how ESG factors are essential for risk management, value creation, and stakeholder trust. IFRS framework. The foundation IFRS S1 and S2 standards provide for consistent, comparable, and decision-useful sustainability disclosures. Materiality and disclosure requirements. Guidance on determining what ESG information is material and how to disclose it effectively. Sector-specific guidance. Recognizing that ESG risks and opportunities vary by industry, requiring tailored approaches. Governance and accountability. The critical role of boards, management, and internal controls in embedding ESG into business strategy. Tools and resources. Practical aids for data management, assurance, training, and communication. Effective communication. Strategies for transparent and meaningful stakeholder engagement. Future outlook. Trends such as technological innovation, regulatory harmonization, and enhanced assurance shaping the future of ESG reporting. Case studies. Real-world examples demonstrating successes, challenges, and lessons learned. 36.2 Reflecting on the ESG journey. ESG compliance is a continuous process, not a one-time effort. Organizations must stay agile and adaptive to evolving standards and stakeholder expectations. Invest in building ESG capacity across the organization. Embrace transparency and accountability as foundational principles. Leverage innovation and collaboration to overcome challenges. 36.3 The strategic value of ESG compliance. Beyond regulatory compliance, ESG disclosure under IFRS drives enhanced risk mitigation and resilience in a rapidly changing environment. Improved access to capital as investors increasingly prioritize sustainability. Strengthened reputation and competitive advantage. contribution to global sustainability goals, and positive societal impact. 36.4 Final recommendations. Start early. Begin integrating ESG considerations and IFRS disclosure requirements promptly. Engage stakeholders. Foster ongoing dialogue with investors, employees, regulators, and communities. Ensure quality. Prioritize accuracy, completeness, and reliability of ESG data. Build governance. Embed ESG oversight within corporate governance frameworks. Monitor progress. Regularly review and improve ESG reporting processes. 36.5 Closing thoughts. The convergence of IFRS standards and ESG principles marks a new era in corporate reporting. This transformation offers a unique opportunity for organizations to lead responsibly, innovate sustainably, and create enduring value. Success in this endeavor requires commitment, transparency, and continuous learning. As the ESG landscape continues to evolve, those who proactively embrace these changes will be best positioned to thrive and contribute meaningfully to a sustainable future. Thank you for exploring IFRS and ESG compliance. May this guide serve as a valuable resource on your sustainability journey. About the author. Olubusayo Aina is the director of LAREINS, an energy, climate, ESG, and sustainability training institution. He is also a professor with the Global Humanistic University, GHU, in Anguilla. Olubusayo has a PhD in energy economics and finance.